Good morning, everyone. My name is Chukwuemeka Ezechukwu with the Impact Investors Foundation, and I'll be your host, your MC for today. It's a wonderful day, and I'm so happy to have welcomed everyone who has made it here, taking a very time off your busy schedule to be with us here today. So you're formally welcome to the Impact Investors Foundation Investors Roundtable with the theme, Catalyzing Impactful Investments in Nigeria, Unlocking Opportunities, Driving Sustainable Growth. Please, a round of applause for yourself, everyone, please. Thank you so much. You're all looking beautiful and handsome today. So before I get right into the next agenda, I would like to actually recognize our distinguished ladies and gentlemen who are here with us, kicking off with recognizing our chair, Mr. Frank Aigbogun. Welcome, sir. As every time I get to see him, I have to smile because that is where my salary is coming from. So please pardon me. Also, excuse me. Also welcoming Mr. Benson Adenuga, the country director of British International Investment. You're welcome, sir. Thank you. Also want to recognize the presence of Ms. Alice Dada, the country director of Risa Fund, the country lead of Risa Fund. Thank you. Also want to recognize Mr. Gucci Aguda, who is also a member of the board of NABI. Welcome, sir. And also, everyone here in the room, our investors, our partners, our colleagues. As the event goes on, I'll continue to recognize and welcome the distinguished people who will be joining us. So to kick off the event, we'll have a welcome address, which will be delivered by Ms. Etemore Glover, who is the CEO of Impact Investors Foundation. She'll be delivering it online. Do we have her on?
Can you hear me?
Yes, CEO, we can hear you.
Okay, I'd like to say that the internet bandwidth is poor. If you can change the internet bandwidth, that would be preferable because I'm also struggling to hear you. If you can hear me, I'll go ahead with my opening remarks. So please confirm you can hear me.
We can hear you, CEO. Let's go ahead. Can you hear me?
All right. Thank you. Thank you. Distinguished ladies and gentlemen, all protocols duly observed. I'd like to say good morning and welcome esteemed investors, members of the National Advisory Board for Impact Investments, members of the members of the Impact Investors Foundation, funders, partners. So welcome to this very first Investors Roundtable we are organizing. And this is an opportunity to strengthen partnerships with all of you, our investors, financial institutions, thought leaders, to explore the latest trends in impact investment. With continued support, this roundtable has played a pivotal role in shaping our understandings of investors' criteria and advancing funding opportunities for Nigerian MSMEs. Many of you have been with us from the beginning when we established the Impact Investors Foundation, and our mission was to unlock private capital for impactful investment. And we know for us to grow the volume of impact investment, we need the participation of capital from both the public sources as well as the private sources from institutional investors like pension funds, insurance, and others. Today's conversation is themed Catalyzing Impactful Investments in Nigeria, Unlocking Opportunities, Driving Sustainable Growth. It reflects our shared commitment to accelerate capital flow towards investments that generate both financial returns and measurable social impact. This roundtable seeks to answer many questions, but one pertinent question that we must answer before we leave here today is, what actionable steps can we take to accelerate and enhance the volume, composition, and flow of capital towards impact investment in Nigeria? Through our conversation today, we will highlight the gaps and the current opportunities that we haven't yet fully harnessed within our ecosystem. We'll also identify barriers that impede us from taking advantage of these opportunities. And finally, with your support, we intend to design actionable strategies that can be implemented by stakeholders in the short term to medium term to advance impact investment to arrive at a sustainable development future for our country. So over the course of this event, we have brought together subject matter experts, industry leaders who will provide insights to the conversation. Also, we have a report which was commissioned by the MasterCard, sponsored by MEDA. We'll have insights to the report. And the report will examine how increased local capital domiciliation could attract greater international capital flows into Africa. I would like to emphasize the urgency of unlocking capital for sustainable development in Nigeria. While the impact investing ecosystem is evolving, funding sustainability remains a huge challenge for us. Historically, many impact-driven enterprises have relied on international capital to scale their solutions, and this is evident in the report that the Impact Investor Foundation commissioned in 2019, which showed that development finance institutions provided 80% of the impact capital in the country, while 20% came from local sources. We need to address that, particularly while shifting global financial priorities, rising interest rates, donor fatigue. It is clear that relying solely on international funds is no longer sustainable. To build a resilient impact economy, we must look inwards and tap into local capital pools, including pension funds, government resources, high net worth individuals, and corporate investors. To attract more local investment into impact-focused sectors, we must address key barriers, educate and engage local investors, de-risk investments, and create an enabling environment for private investors. So today's conversation must transcend beyond just discussions. We intend to collaborate with each and every one of you who would like to innovate and take decisive steps to unlock the full potential of impact capital in Nigeria. By doing so, we can empower businesses, create jobs, and drive sustainable development across critical sectors such as healthcare, agriculture, education, renewable energy, etc. I'm immensely grateful to our funders, the Ford Foundation, the RISA Fund of the United Kingdom government, for their continued commitments. Our strategic partner, Bank. I encourage you all to fully engage, share your insights, your thoughts. Let's explore partnerships that will pave the way for a more robust and inclusive impact investment ecosystem in Nigeria. I am confident that the deliberation from this engagement will lead to actionable solutions that will drive progress, foster economic development, and encourage a more robust and inclusive impact investment ecosystem in Nigeria. Once again, I thank you all for your dedication to supporting the growth of impact investment in Nigeria, for those also supporting social enterprises with high growth potential through capital scaling. Thank you so much. We do not take your time for granted. Many of you have left your busy schedule to be with us today. I look forward to a productive engagement and discussion with each and every one of you. Thank you very much for this opportunity and enjoy the rest of the day. Thank you.
Thank you very much. Please, a round of applause. Louder, please. I mean, there's one thing that she actually mentioned in her welcome remarks is that today's event is going to actually result to actionable practices that will grow impact investing ecosystem. So I'm very, very happy to know that we all are actually going to leave to this wonderful room with practice that will actually grow, not mere talks, not mere discussions, but actually things that we can actually put into practice to grow the impact investing ecosystem. A round of applause for her once again, please. Also giving a good remarks, we're kicking off that with Mr. Frank Aigbogun, the chair of Impact Investors Foundation. You're welcome to the stage, sir. Please a round of applause for him for his opening remarks.
Good morning, distinguished guests, esteemed panelists, ladies and gentlemen. I think my task this morning is perhaps the least, and it is to add my welcome to that has been so expertly given by our CEO, Tamara. I have profound pleasure in welcoming you all to this event. We see it as an important gathering of minds that are committed to the future of impact investing in Nigeria. On behalf of the board of IIF, our partners, I extend my heartfelt appreciation to all of you for taking time to be here this morning. Tamara, in her welcome, alluded to something that, for me, is quite central. The fact that it is time to begin to catalyze domestic capital for impact investing in Nigeria. It is not that we do not appreciate the international flows, but I think that we have a duty and a responsibility to begin to work harder than we have done in the past, to begin to persuade investors about how nice it is, not only for financial returns, but also returns that may not be measured immediately financially. Nigeria, for its size, both in terms of the population of our people and as well as the size of its economy, I think it just doesn't add up when you look at that data that Temore provided, that 80% of capital geared towards impact investing comes from our development partners. While we salute our development partners, I think it's hard to even imagine where we'd be without them. But for investors, domestic investors that are gathered in this room, I think it's important to begin to look at how we can begin to put our money where our mouth is. And I'm sure we are capable of doing that. We have seen people deploy capital very efficiently, bring in returns that are quite enviable. I think what we need to do now is just to tweak that a little bit and to begin to create a good portion of capital that we can direct towards impact enterprises. As I said earlier, mine is a very it's a small task. I'd like, once again, on behalf of the board of IIF and our partners, to welcome you here this morning to today's event. I have absolutely no doubt that the time that you have chosen to spend with us this morning will be a productive one. I know that there's a lot that's been lined up today, at least 2 panels, and we have some of our panelists here already. So I think it's the good thing for me to get out of your way so we can truly get started. Once again, I welcome you warmly. Thank you very much.
Please, let's continue clap now to the seats, please. Here's my chair. Thank you very much, sir. I will just a recap of one major point that he actually said. It's actually time for us to put our money where our mouth is. We can no longer rely on the international inflows. We have to actually do it ourselves also. Thank you very much, sir. Please, another round of applause for him, please. Also, to give a goodwill remark is Mr. Tunde Mabawonku, the Executive Director, Retail and Digital, Wema Bank. You're welcome, sir, to the stage.
Okay. Good morning, ladies and gentlemen. My name is Ayodele Olojede, and I'm here representing the Executive Director today, Mabawonku, to give or to deliver his goodwill message for this program. So, distinguished guests, esteemed partners, and fellow advocate of impact investing, I am Ayodele Olojede, the Divisional Head for Retail and SMEs for Wema Bank, and it is an honor to stand before you today. This year, Wema Bank proudly celebrates 80 years of excellence, 80 years of resilience, and 80 years of transformative impact. Over the decades, we have remained at the forefront of financial inclusivity, economic empowerment, and sustainable growth, consistently driving initiatives that not only yield financial returns, but also create meaningful social impact. As a financial institution, we recognize our critical role in shaping a more inclusive economy. Our commitment to impact investing, strategically deploying capital to generate both economic and social value is evident in the many, many initiatives that we have spearheaded. Wema Bank has continuously innovated to empower MSMEs, support female entrepreneurs, and drive job creation, ensuring that financial empowerment reaches those who need it the most. Our journey has been marked by numerous milestones, including the Platinum Award for Best Financier for Women Entrepreneurs in Africa by the Global SME Finance Forum and the SME Financier of the Year African category for 2024. And through these initiatives, such as the iPhilanthropy in partnership with the Nigerian Office of Philanthropy and Impact Investment, alongside the Office of the Vice President, we are channeling the $200 million in catalytic funds to support startups in key sectors like furniture, fashion, renewable energy, and agribusiness, and with 50% to be allocated to women-led businesses. Beyond funding, Wema Bank has actively invested in entrepreneurial capacity building programs, in digital transformation programs. For example, the FGN Alaska Innovation Program, targeting over 3 million youth and SME with training in financial support that the bank commenced early last year. And to date, we have been able to train over 500,000 MSMEs in the country. Our annual Alcoholics program, which has provided over $250,000 to tech startups and innovators, fostering a culture of problem solving as well as disruption facilitation. Our accelerator programs, which has also disbursed about 100 million in grants in 2024 and trained over 28,000 entrepreneurs in essential business skills. The bank has also facilitated a 75 billion loan facility that's been dedicated to female business owners in the last 2 years, ensuring that they can scale their ventures sustainably. Our trade fair initiatives, which has given over 10,000 female-led entrepreneurs exposure to over 135,000 buyers, with 70% of them being first-time exhibitors in global market, including London and recently in Accra. At Wema Bank, we understand that access to finance must be complemented by access to market, knowledge, and to networks. This belief continues to drive our mission to uplift Nigerian businesses and to create lasting impact. So as we gather for the 2025 Impact Investor Roundtable, we reaffirm our commitment to leveraging financial innovation for social good. We look forward to meaningful conversations that will drive sustainable development, innovation, and economic transformation. So I say welcome, and let's create lasting impact together. Thank you very much.
Thank you very much. Please, a round of applause for her once again. Wema Bank are actually among the sponsors of today's event, and what they continue to do for the impact investing ecosystem through their initiative for women-led women entrepreneurs is remarkable. The start Krichia read out the funding that are available for entrepreneurs in our ecosystem that are impact investing focus is a wonderful achievement for Wema Bank. Once again, a round of applause for Wema Bank and also for her. Also delivering her goodwill remarks is Ms. Alice Dada, the country lead of Riser Fund. Please, a round of applause as she comes up to the stage.
Is this on? Okay. Good morning, everyone. I think I'm very happy to be here today because I know these conversations that we're about to have will be quite impactful. I want to just reiterate and appreciate what the chairman had, mentioned up here. It's quite important that we not rely on just development partners to drive our own economy. And I say that from a place where our focus has shifted from us just providing support and technical funding to our partners, but more so to sustainability. So beyond the support that we provide, we want to support partners that are more intentional and partners that are looking to make impact because they're passionate about it and because they see the necessary need for their work in the economy. And at the Rise Fund, our focus is quite clear. We are to come in and to support our partners in strengthening the research and innovation ecosystems. And we're not doing that by ourselves because we have partners like the Impact Investors Foundation and the Impact Investing Ghana to ensure that our support actually reaches beyond what we can ever achieve. And so, most importantly, it's really good for us to collaborate and to identify the key players and not just say, you know, we're going to do this by ourselves, but we're going to identify who the policy makers are. Because regardless of how difficult it might be to work with them, they do make an impact. And it is left for us to help them make the impact that is right for us. And not to take up too much of your time, because like the chairman said, it's not really about us. Our job over here is quite easy, to come in and to speak and deliver goodwill. But most importantly, I would like for us to ensure that we identify key players within this room and even beyond this room and spread the word about impact investing. Thank you very much, and I hope that we have a great day.
Is it a round of applause for her, please? Always wonderful to have you in our midst, Ms. Alice. It's a pleasure. And what Rise Fund continue to do for the ecosystem, it's actually a remarkable one. Supporting not just only Nigeria, but also Ghana and also the wide West Africa and Africa at large. Thank you so much. A round of applause for her, please. And just like she has said, and also my chair has also said, that the conversations that we're going to be having here is going to be a remarkable one that will lead to an impactful partnership, one that will lead to an impactful collaboration, and one that will lead to tangible and recordable results. That is actually a very nice segue into our next speaker, who will be setting the stage on impact investing in Nigeria, past, present, and future. Delivering this speech is Ms. Tochi Ginigeme, the deal matchmaking manager for Impact Investors Foundation. Please, a round of applause for her, please, as she comes to the stage.
Thank you very much, Chukwuemeka. Good morning, everyone here. Good morning. Good morning to our distinguished guests online as well. We thank you so much for joining us. And depending on where you're joining us from, it's probably still early, so we appreciate your time. My name is Tochi Ginigeme, and I'm the Deal Matchmaking Manager at Impact Investors Foundation. My job, essentially, is to help facilitate finance flows from impact funds, much like yourselves, to high-impact businesses. And much has been said today about how important this role is, and how it's our mandate here in this room today to ensure that businesses within Nigeria get access to capital. Before I proceed, I would like to take us back to the year 2015. This was the year when all 193 member states of the United Nations signed the Sustainable Development Agenda. Today in the room, we have business leaders who can appreciate what it takes to get 193 member states to sign a consensus to advance sustainable development. What this tells us is that sustainable development is desirable, And it can be said that it's a common denominator of our human experience. A world where there is zero hunger, where access to childhood education is prioritized, where maternal mortality does not exist, where the youth have access to employment opportunities, dignified employment opportunities. Sounds like utopia, doesn't it? Sounds almost too good to be true. When the topic of impact investing comes up, as it often does, we hear pushbacks. When we reach out to fund managers every now and again, we hear things like, "Oh, Touch, our fund does not do impact investing." And then I wonder, what does it mean to do impact investing? Regardless of whether or not we measure impact, impact is happening. Regardless of whether or not we choose to be intentional about it, it is happening. And when we talk about sustainable development, as has been said by our CEO and our board chair, Mr. Frank, we've left it for too long in the hands of development finance institutions, partners that we appreciate, but partners that we know cannot bear the burden of development of our country. I'll share a quick stat with you. About 70% of the global funding pool is concentrated in the private sector. In emerging markets, that number goes up to about 80%. The people sitting in this room today, working across pensions, investment banks, venture funds, private equity, have more power than we realize. And that's why we've created this platform, hoping that it will be an arena for us to have meaningful deliberations and concrete action plans that can steer our country, Nigeria, towards the path of sustainable development. So what can we expect from today's event? Well, we've already heard brilliant speeches, thanks to our CEO, Ms. Etemere Glover, and our board chair, Mr. Frank Aibogo. We would also hear a couple more keynotes from expert practitioners who have spent decades of their career working to facilitate finance flows towards impact sectors. Later on, we would have a panel conversation around scaling impact initiatives. I enjoin you all to participate in the panel discussions, to ask questions, to challenge narratives, and let's find where that path is that can lead us to achieving our sustainable development goals. After the tea break, things get a little bit more exciting. That's when we'll have the breakout sessions. Our breakout topics will be focused on a recently published study by the Mastercard Foundation in collaboration with MEDA. This study is really around making Africa, and for the purpose of this event, making Nigeria an attractive location for local fund domiciliation. It's about time, if you ask me. No more British Virgin Islands, no more Mauritius. Sorry if we have Mauritius nationals in the room. But it's time for us to keep that capital home. And then finally, we would have our lead roundtable speakers, industry leaders in every right, come forth and present to us their findings. These findings will not end at this conversation. No, this is not another talk shop. We're going to get into action. We have repertoires that will be seated amongst you, documenting findings that we can take away from here, and hopefully findings that we can hold each other accountable to. So it's a small event, it's an intimate event, but we believe that the power in this room, the strength of our collaborative efforts, can indeed make a change. If not now, when? And if not us, who? Thank you very much.
Please, a round of applause for her. Please continue, please. I think her speech actually is quite touching, I must say. And she has also informed me that everyone with their buying statement, it will be recorded and each person's name will be written in each commitment. So let us be aware that as we make commitment today, the next day you'll be seeing us in your office to remind you of what you said and literally move to action. So I had to disclose that. And also, she also mentioned and also listed out a whole lot of the activities that actually lined up today. I can actually assure you, you will actually be enlightened. You will be moved to action from the various activities of today's event. Thank you so much. Please, another round of applause for her. She actually had a wonderful speech. I couldn't have delivered it better. Please, let's continue, please. For our next keynote, the first keynote speech today, which delivering on the theme, Navigating the Impact Investment Landscape in Nigeria, Insight, Challenges, and Opportunities. This will be delivered by Mr. Benson Adenuga, the Country Director, British International Investment. You're welcome to the stage, sir. Please, a round of applause. Please, louder, please. He's also part of my salary payers.
Good morning, everyone. And it's a pleasure to be here this morning to talk about navigating the impact investing landscape in Nigeria, insights, opportunities, and challenges. As we say in Nigeria, please permit me to stand on all existing protocols. As mentioned, my name is Benson Adenuga. I am the country director for BII, a role I've played for the past 5 years. And I've been in the impact investing landscape now for about 15 years. And before then, I was in private equity. So I think this is a very important topic for me as an individual and also for my organization. So when we're looking at the importance of impact investing, I think the lens from which I begin to look at it is just describing the enormity of the development challenges in our country. I think it was Tochi was talking about the SDG goals established so many years ago. If you look at SDG 1, it says no poverty. SDG 2 says zero hunger. 3 says good health and well-being. And 4 says quality education. But what is the reality in our country today? According to the MBS, which is a government-owned Bureau of Statistics, they told us that 63% of Nigerians, that's 133 million people, are multi-dimensionally poor. The World Food Programme estimates that in 2025, 33 million people will face acute food insecurity in Nigeria. Unemployment, the way the MBS decided to change the formula, is 5.2%. Even at that number, assuming we're 200 million people, and 5% cannot find work for 1 hour in a week, that is a large number. 10.2 million primary school age children are out of school, and 8.1 million junior secondary school age students are out of school. According to the World Bank, there are 4 physicians per 10,000 people in Nigeria. And this was 2022. With everything that's happened in the past 2 to 3 years, you can just imagine where that number is today. And then NESG, quoting the State House, mentioned that there are 28 million housing unit deficit in Nigeria. You look at all these dire statistics, to my mind, I think is indicating challenges, but at the same time, opportunities. There's something I read some time ago, that 2 people who were involved in selling shoes went to a particular location. And when they got there, realized that everyone was barefooted. One said, let's go. There's no opportunity here. They don't wear shoes. The other person said, you're missing it. This is an opportunity to sell them shoes, and they begin to wear shoes. Depends on what you see. So to my mind, these are challenges, but I also think there are opportunities at the same time. So what do I see as opportunity in this country? Let's take food security. It's a major issue for us in the country, but it also throws opportunity. How do we support the smallholder farmers who account for the majority of agri-production in our country? How about food processing? How do we handle the post-harvest losses we have? It's an opportunity. How about financial inclusion? There is a huge gap today in terms of SME financing, the right type of finance they require. Also, even gender, women-owned businesses. How do we handle that? We have a very huge youth population. We know they are talented, they are tech-savvy, but many of them are unemployed at the same time. That's an opportunity the way we look at it. Nigeria and Africa contributed much less to global warming, but the vulnerability today, we are bearing that. So what do we do about adaptation and resilience mitigation? Those are opportunities. We talk about infra deficit, whether you're talking power, transportation, digital. The point I'm making is that these are significant opportunities for impact investing in our country. But as we all know, the potentials are huge. But the reality is, we're not tapping the potential. So the question is why? Are we not tapping the huge potentials that we see, in the impact investing space? So talking about the challenges, the way I look at it, I do think that there is still a limited understanding of social entrepreneurship in our markets, in our country, among a number of investors, among governments. People understand grants and aids. People understand commercial investing, but social entrepreneurship, I think, is still not well understood in our market today, and that limits what we are able to do in that space. I also do think that the ecosystem is not supportive enough in terms of policies and regulations guiding impact investing and social entrepreneurship, and the incentives as well to encourage impact investing, I think, is very limited in our country compared to what we see elsewhere. How about the business environment in which people are operating? This country, let's be very honest, presents very challenging business operating environments. Whether you're talking poor infrastructure, inflation, we're seeing our foreign exchange rates trying to stabilize now, but we know where it came from. So it continues to be challenged. How about the bureaucracy? Try to do anything in this country that has to do with government. Try to export things out of this country. Try to clear containers coming into this country. It is challenging. And that is a problem for impact investing as well. In terms of financing structure, when we're doing impact investing, the type of capital you need, sometimes catalytical capital, the seed capital people sometimes need, long-term capital, the right currency sometimes is not available. Those are challenges that I think we need to deal with. We all realize that SMEs account for a significant part of employment, economic activity in our country. But how much of capacity building actually exists to support these SMEs that are very important for our economy, I think is very limited. We see a number of measures, a number of schemes put in place to assist in financing SMEs. It's still a drop in the ocean, but the gap in terms of capacity building continues to exist in our market. The one point I also want to make is that I think the path to sustainability, sometimes we need to start with constitutional funding, cheap funding, to support some initiatives. But the reality is, businesses cannot continue perpetually to depend on cheap constitutional funding. There needs to be a path for businesses to be able to grow and be able to access commercial funding, so then we can actually crowd in more funding to support impact investing. Sometimes we see businesses requiring this cheap funding, which is fine at the beginning, but it cannot continue to be like that. And of course, there is the geopolitics. We all see what has happened with, the new government in the United States. We all see what is happening with US aid, what's happening with, DFC. It's a challenge. And it's not just the US. We're seeing, some other countries reducing the ODA budget as well. So I think these are really the areas where we have seen challenges for impact investing. But having said that, I would say that impact investing actually, I think, is growing. It's not enough, but I think it's growing. If I look at what we're doing at BII, for example, I would say that there has been a lot that we have done, even though I think it's definitely not enough. So you look at working with smallholder farmers. We have invested in businesses, aggregating smallholder farmers and supporting them across the entire processes, providing them with inputs, providing them with warehousing facilities, helping them with access to market. And we've been able to do that successfully without losing money. We've invested in agro-processors. There's a deal we announced about a month plus ago where we supported John Vance, a cocoa processing company in Ondo State, to expand their capacity to be able to actually do more in the market. We've worked with agri-input manufacturers. We've supported solar home systems to help businesses to be able to access sustainable power. We've been involved in financial inclusion, giving money to intermediaries to support SMEs and women-owned businesses. We are active investors in venture capital. All the major VC funds in this country today are basically our GPs that we have supported. The same with SME-focused PE funds as well. So I think to wrap up, what are the approaches that we have taken that I believe has actually helped us, which I think can support others trying to do more in the impact investments? But the first one I would say is that I think we need to clearly define the area of focus, and that will depend on the expertise and the competence you have. The broad areas of impact investing, it's actually quite large, and no particular investor can address all the entire spectrum. So I think to be able to make the right kind of impact, we need to define the areas of focus where we are well positioned to be able to support. The second point, we need to be intentional on our risk appetite. So for us as BII, for example, we've got different pools of funds. There is a fund called Kinetic. What it does is, it's in the climate space, but it's set up to take very high risk opportunities, but that can deliver significant, impact. And therefore, the risk is that we can lose the money is high. On the extreme end are what we call our growth capital, which is more like established businesses, lower risk, and some impact. So people need to define, what am I actually doing? And how do I address these pocket opportunities? In addition to that, I think the appropriate capital pool is important, as I mentioned. Sometimes we need high-risk seed capital to support initiatives. Other times, it has to be blended finance that we actually provide. And unless we are that intentional, I think people will be discouraged. In addition to that, I think we need blended finance. There are initiatives that require catalytic capital at the very beginning to get them off the ground, demonstrate and prove the concept, and then crowd in commercial capital later. That approach actually needs to be followed. In addition to that, I mentioned capacity building before. We need to be able to support businesses. There's a deal, we did in Ghana where we actually established BII, an SME financing company. We owned it majority. The management team hold a minority stake in the business. And what they do is providing local currency capital to SMEs. But to support that, we have a TA program that we established to support businesses that we are financing. Sometimes it's getting them finance ready. Other times is assisting them to grow their businesses. I think TA and capacity building is critical. Beyond that, I do think that this calls for partnership and collaboration. No one firm, no one group of people can do it. It's going to involve, a number of people. And I think the ecosystem as a whole needs development. The opportunities are there, the challenges are there. I think we have no choice. This is why some of us decide to play in development finance, because of the impact it can deliver. And our nation, we need it, and we all need to put heads together for us to be able to deliver the impact that our country, our people need. Thank you very much.
Thank you so much, sir. Please, another round of applause for him, please. BII they are actually a very, very huge supporters of impact investing in Nigeria, deploying so much capital in the system. Another round of applause for him, please. Also, so moving to the next agenda, we have a second keynote speech, which will be delivered by the theme of the speech is reinforcing local investment ecosystems amid global disruptions. This will be delivered by Ms. Tosin Ojo, partner Sahel Capital Agribusiness Managers Limited. Please a round of applause for her.
Good morning. Good morning, everyone. My name is Tosin Ojo, has been introduced. Let me also stand on existing protocol, but thank you, Benson, for your keynotes. I think you set the stage for a lot of things that I also have noted in the topic that I've been given, which is reinforcing local investment ecosystem amid global disruptions, right? And I think that some overlaps and commonalities. So it's a privilege to be here, and I want to appreciate the board and executive management team of IIF for the opportunity. I'll approach it from more like a global picture and just try to emphasize some of the things that Benson also had mentioned. And BII is also one of the investors in our own fund, Sahel Capital, to reinforce some of the things that he has said about the effort and the impact they've been having and trying to have in impact investing on the continent. But I'm going to spin the conversation today and be a little bit more aggressive on the domestic investors, because if we really want to be making the difference that we need to make, then we need to have the hard conversation and the frank conversation. Right, this topic is quite apt for the moment. Many of us, we've been following the news and we know what's going on in global geopolitics. There have been strong disruptions in the flow of capital, especially from the global north to the global south. We all know the news about USAID, but the reality is that USAID, maybe because of the way in which it was done, it was really disruptive. But for the last, say, 2 years, there's been a realignment and a shift in the priorities of a lot of the institutions and countries from developed countries in terms of capital flow to the global south, as I mentioned. For example, the FDI flows from to Sub-Saharan Africa, declined to about 25 billion in 2023 from about 65 billion in just 2 years. And that's according to data from the World Bank, right? So between 2021 and 2023, it's almost a $40 billion evaporation in flow of capital to sub-Saharan Africa. And so we need to start having real conversations, right? You know, understandably, and I'm saying that because African economies have underperformed because of currency shocks and a lot of macro shocks, right? So we need to have this conversation. Yes, it's impact investing, but this one of the things that is very critical about capital is that capital has always been finite. Capital has always been finite, and perhaps capital has even become more scarce as it is finite. And therefore, because of that, we need to have critical questions around what is causing the limitations around mobilizing more capital into impact investment in Nigeria specifically, as we're talking right now. You know, the problems that beset us in Nigeria and on the continent, and these problems that need funding solutions, are increasing at a rapid pace. You know, we still have one of the highest food prices in the world, chronic food insecurity. More people are taking less and less food. People are rationing. There's acute malnutrition. The average Nigerian household spends about 65% on food. The figures are lower if you look at Egypt or Kenya. They are not exactly super attractive, but at least they're better. They're better than ours. And so if an average household is spending 2/3 of their income on food, that's the most basic need for human for human survival. What about education? What about healthcare? Right? So we say we have a population, but do we really have the market? What do we need to do? Right? About housing deficit, all of this data have been mentioned, out of school children. So we have a lot of problems. Credit penetration is low. Perhaps on any human development metrics that you're going to pick, we are behind. Our population is a dual-edged sword. It's an advantage if we act quick, and it's a burden if we continue at this pace. And like I said earlier, yet we face one of the most significant capital constraints perhaps in the last 20 years. You know, because of the realignment in geopolitics. For example, about 2 weeks ago, the UK government announced they'll be reducing aid to emerging developing countries because they have to shore up defense spending. So we need to wake up to the reality that there's no savior that is going to come from anywhere. I'm speaking about reinforcing local investment ecosystem. We need to wake up to that reality. And the question is, what do we need? What therefore do we need to do? How do we start mainstreaming impact investment? How does it become mainstream and not some fringe thing that we talk about the do-gooders, and maybe if they do something and we have, well, like, it's fringe. How does it become mainstream, right? The reality is that we have no choice but to galvanize domestic resources and to put them to best use, to put them to most effective use. But the good news also is that we have some advantage. We're not starting from nothing. Pension asset is currently 22.5 trillion naira. That's about $15 billion. Insurance asset is much lesser. It's about 343 billion naira. That's just $230 million. Total bank savings pool in Nigeria is 85.5 trillion naira. That's $57 billion. I'm deliberately calling these figures because these are institutional domestic pool of capital that is here. And that is here, you know. And you take the top 10 banks in Nigeria. The combined shareholders funds of the top 10 banks is almost equal to the entire AUM of the pension industry. That's about 20 trillion naira. That's about $14 billion. So we're not starting from nothing. So the question is, why are these funds not mainstreamed into impact investing? That's really the question we need to answer. Because if we don't answer the question and prefer the solutions and really, really think critically about what are the local solutions, we're going to continue to have these conversations, and it's still going to continue to be fringe. I interact with, in my work, I interact with investors a lot, institutional investors, development finance institutions, domestic investors, the largest pool of capital that we have, banks, pension funds particularly, right? And we need to start listening and figure out what really do we need to do to bring all of the issues and the concerns to the table and mainstream impact investment. Now, like I said, we're not starting from nothing. This domestic institutional pool Of course, many of them have constraints on how they can be used because of regulators and all of that. But if you take the banking sector, for example, there is now the ability of banks to have ODCO structures, which effectively gives ability to do other types of capital structures outside of their bank balance sheet, right? Even though the regulation is there for the core bank, but there are now these other opportunities. The pension industry has tried to be progressive in terms of their regulation. Over the last, say, 10 years, expanding the allocation that the fund managers can put in alternative assets, which really are the assets that will focus on many of these areas of impact investing that we've mentioned. Over the years, and all of those things have been done. So there's a way in which they can increasingly play an active role in impact investment. But the real question we need to answer is, what do we need to do to deepen the exposure and interest of domestic capital providers to impact investment? That's the question. What do we need to do? Why are they not investing? What do we need to do to deepen their interest here? It's the most appropriate capital pool because there's no currency mismatch, right? They say, for us fund managers in Nigeria, in most of Africa, emerging markets, it's an extremely tough job because when you even deliver great returns operationally on the company, you are facing a huge headwind about currency returns. Your counterparts in the United States don't have that headache. They invest in dollars, they get their returns in dollars. Everything is benchmarked to their ability to add alpha to the companies that they've managed, right? So the domestic capital pool is the most appropriate capital pool if we truly want to make the impact that we want to make, because there's no currency mismatch and all of that. But yet they're not that interested. The interest has started growing, but they are not that interested. So I'll ask the question again: what do we need to do to deepen the exposure and interest of domestic capital providers to impact investment? The question has many answers, but today I'm going to give one. Like I said, my work or my intent here today is to push the needle to make us have the hard conversation on the back of this keynote. So there are so many answers to that question, but I've come with only one answer, and that my answer is returns, returns, and returns. That's the answer I'm going to give. Yes, I know it's overly simplifying the answer to the question. There's so many things we need to do. But I have chosen this one answer as the answer that we need to solve, because if we solve that right, then we can bring all of the other things on board. And that's the only answer I want to give: returns. It's oversimplifying it, but that's where I will start from, right? The sustainability of financial returns is at the core. And I'm not just talking about returns, I'm talking about the sustainability of financial returns itself. I've not mentioned whether the returns should be commercial or should not be commercial, but the fact that the financial returns have to be sustainable is at the core. Domestic capital providers are very commercial in their mindset, and that is just the fact, because the mandate of the people who have given them the funds to manage is commercial. We're all sitting down in this room, we all have pension, right? Honestly, how many of you, indicated by raising up your hand, would say, put my pension in a VC startup? Right now, as we are here right now, put all my money in a VC startup because, and it's a frank conversation, because that is where I want to, have the impact. When you know that 95% of times VCs will fail, how many of you here will make that decision? Okay, so you see that's where the issue is. We need to now have conversations. Now, that does not mean that impact investment cannot be done. Maybe it's not the traditional way in which VC is being done. So the question is, what do we need to do to ensure that there's going to be returns and there's going to be the sustainability of those returns? Because that is the fiduciary duty these domestic capital providers, that's the fiduciary duty that they have. Until we answer that question, we're going to continually say the same thing. The sustainability of financial returns is at the core of impact investing, because there is no impact that can be sustained if the financial returns are not sustained. And I'll take that again. The sustainability of financial returns is at the core, should be at the heart of impact investing, because impact will not be sustained if financial returns are not sustained. So that's the first point I want to make. The second point is, I've given some data about the domestic pool of capital that we have, but it's not enough. We have huge problems that we need to solve. It's not enough. So that brings me to the second point, and that point is leverage. And by leverage, I don't mean debt. I mean, how do we use capital in a catalytic way? What is the appropriate way to use capital to deliver maximum impact, like outsized impact for every dollar? What capital is best suited to what? How do we align different incentives for different capital providers in a way that it maximizes the leverage of each naira or dollar to deliver maximum impact? There's a term that we use generally in impact investing. We call it blended finance. But I'm sort of trying to explain the concept behind it, because there are different capital providers and they all have different objectives. So instead of working in silos, how do we galvanize capital together and make their impact more significant, because now we have a greater pool, and in that greater pool of capital, everyone on the cap table have their incentives catered for, right? But then we have more capital, and then for every dollar that we then deploy, or every naira that we deploy, then we can have outsized impact or maximum impact. That's the second point. So that we stop working in silos and have different things, all of us trying to do the same thing. So how do we combine the effort in a way that whether you are a development finance institution or you are a commercial bank that has an holdco structure and wants to take exposure in the risk sector or in impact sectors, or you're a pension fund administrator, how do we bring all of you on the same table in a way that we cater to all the incentives that you have, but the result is we have a broader, larger pool of capital using foreign capital and domestic capital in a way that we can then maximize the impact of every dollar that we deploy. And the last point, second to the last, as I'm wrapping up, is the role of government. The role of government, I would say, is very simple. There are so many things government have been trying to do, but neglecting the most important thing that they should be doing. The role of government is to be clear, and I think we need to have a consensus on this and be clear. All of us in the private sector, we need to have a consensus and be clear. The role of government, I think, in a simplified sense, is to provide a stable environment where productive economic activity can take place with minimal frictions and where returns can be predictable as a direct function of expertise, innovation, and execution. And I'll take that again. The role of government is very simple. In a very simple sense, provide the stable environment where productive economic activities can happen with minimal frictions and where returns can be predictable as a direct function of expertise, innovation, and execution. Which means remove all of the issues, the legal bottlenecks, all of those issues, such that if people put capital to use, the performance they get or the return they get is a direct function of their expertise, their innovation, and how they've executed. We shouldn't have to be worrying about currency and all of those things. Like, create that stable environment where you put capital to use, and you know that to a large extent, what you get out of that capital is a direct function of your expertise, of your innovation, and how well you have executed. Finally, I'm going to wrap up, and I'll talk briefly about impact investing model in South Africa. The biggest investors, apart from foreign investors, in the impact investing ecosystem in South Africa are their pension funds. The government employee pension funds has about 1 million employees, and if I remember correctly, over $300 billion in assets. And they are one of the biggest investors in the impact investment ecosystem in South Africa. So the question is, what have they done? The pension fund investors there also have return expectations, as I've mentioned. And they also have, the fund managers also have fiduciary duty to their employees. Out of this 1.3 million employees in the government of South Africa pension fund that I've mentioned, about 560,000 are active retirees, which means they have active obligation to them in terms of the decisions that they make. But yet, they've been the most active in the impact investing ecosystem, right? So the real question is, what can we learn from them? And how can we then use that model here in Nigeria? If certain things have been done, there's no need to reinvent the wheel. We can look at the models that have worked. of course, adapt it to our own homegrown realities, and then see how we start mainstreaming impact investing as the core strategy of domestic institutional investors, and stop moving and move it away from fringe, from something that, you know, they just do on the fringe, to something that is mainstream to their investment strategy. I'm going to end with this. You know, now more than ever, all of us, all of the actors, we need to galvanize scarce and finite capital. That's where I'm going to end. Capital is finite. As of today, we can calculate the entire capital stock in the world. It's finite and it's scarce. As we're looking for capital, every country in the world is looking for capital to solve the problems that they have. Capital is finite and capital is scarce. So how do we start using capital in the most effective way to deliver accelerated and outsized impact? But first, putting the sustainability of capital at the core and ensuring that we deliver good returns. Thank you.
Please, a round of applause. What a wonderful speech. Thank you so much, Ms. Tosin Ojo, partner, Sahel Capital. She actually hit a lot of vital points. Such point that we actually hear. I think one thing I would say, she didn't hold back any punches. She actually hit it. One thing that she actually mentioned, that capital requires returns. And also talking about the various capital pool that we have in Nigeria. There's some Mr. Oguchi, I'm sure, when he kept hearing about the need for the pension fund to actually play a very vital role in this impact investing space, it gave him so much joy, because he has been a huge advocate of the pension fund playing a huge role. He's the CEO of the PenUp, and he continuously drives that conversation. Sitting on top of a large pool of capital, the pension fund has a huge role to play. And I would say these kind of conversations, and not just conversations, as she actually pointed out, roadmaps, actionable practices that are already working in our large African ecosystem that can also be applied in Nigeria. So please, investors in the room, and also regulators also here, and also our participants online who know and understand the vital role that we all need to play in driving capital to those who need it, and also ensuring that capital gives the right return. A round of applause once more for her, please. Thank you so much. And so we'll be having our first panel session. Before I actually move on to the panel session, please, the online participant, can they hear us? Actually, I was informed that they're having a bit of a online.
Yes, we can hear you loud and clear.
All right, thank you so much. To call on the panels, the theme of this panel conversation is centered around scaling impact initiatives to attract and mobilize capital for sustainable investment. Among the panel is Ms. Adesua Okumbo Rhodes, who is the founder and CEO of Arua Capital Management. Please, a round of applause for her as she comes to the stage. Also joining her on the stage is Mr. Andrew Amara Tarazi Tarawali, who is Investment Director of Small Foundation. A round of applause for him as he comes over to the stage. Also joining them on the stage is Mr. Akinwande Pierce, Technical Advisor, GIZ Nigeria and ECOWAS. Thank you so much, sir. And the moderator of this wonderfully selected panel, hello, is Mr. Muiz Bello, who is the Senior Associate of Africa Capital Alliance. A round of applause for him as he comes over the stage.
Good morning, everyone, and thank you for taking the time to be with us today. It's truly a pleasure to be here. My name is Moise Bello. I'm a senior associate within the investment team at African Capital Alliance, and I'll be moderating this panel themed Scaling Impact Initiatives to Attract and Mobilize Capital for Sustainable Investments. Now, to dissect this topic, I have three experienced professionals here with me with a track record of impacts. I would now invite each of them to introduce themselves. To the panelists, as you introduce yourselves, I would kindly ask that you elucidate the room as to what impact means to you generally, as well as within the context of the work that you do every day and why this matters to you. So let's start with you, Adeswa.
Hello. Good morning, everyone. Thank you to Impact Investors Foundation for having me. So I'm Adeso Akumbo Rhodes. I'm the founder and CEO of Aurora Capital Management. We are an early stage growth equity and gender lens fund, investing in SMEs here in Nigeria, but also in Ghana. Impact to us is three pillars. One is job creation. So as we provide growth capital to SMEs, we see transformative growth, and in that growth we see significant job creation across our businesses. So as of today, across our portfolio, we're supporting around 175,000 direct and indirect jobs. So this is something that we track and is something that is very key to our impact pillars. The second is gender equality. So we're one of the few women-owned and managed funds, and we're intentionally investing with a gender lens. So all of our investments must meet one of the 2X challenge criteria. So that's either being female-founded, female-led, having women in senior management, having women active across the value chain of the businesses that we invest in. So gender equality and gender diversity is a big impact pillar. And with less than 2% of capital going to female entrepreneurs on the continent today, it is very relevant and it's very important. And then the third is the enablement of micro SMEs within the value chains of our companies. So as of today, we've generated about $100 million of revenue for value chain participants in our companies. That is either female smallholder farmers, market women using our solar-enabled products, or agents using our POS devices. So the enablement of micro SMEs is also something that is very meaningful to us because this group of people is typically unbanked, they're typically underserved, so we're very, very keen to create value through our investments for these participants as well that drive majority of job creation in our economies. So yes, looking forward to digging deeper, and that's my introduction.
Hi, good morning, everyone, and again, thanks to IF for inviting me. I am an investment. My name is Andrew Amara Tarasi Taroli, investment director with Small Foundation. Small Foundation is a single-family office from Dublin, set up by the Boston family with the overall objective of eradicating extreme poverty in sub-Saharan Africa. So that I would say is our first level of impact. What does impact mean for us? It's about improving the livelihoods of rural communities across sub-Saharan Africa. However, we believe that in order to move more people out of poverty, it has to come through economic activity, and specifically economic activity done through SMEs on the continent that have a rural impact, either through their value chain or through goods and services they're providing to rural communities. So for us, everything we do is centered around SMEs to enable them to scale. And we believe for them to scale, they need access to finance, access to talent, access to technology, knowledge, markets, and networks. So we would typically support, invest in intermediaries that are providing these critical services to SMEs. And for us, we want to see SMEs scale, and by scaling, not only in terms of revenue, but in terms of job creation, in terms of sourcing, and that way we believe they'll have the impact we ultimately want to see. So we've been around for close to 2 decades now, and we've done a lot of, let's say, investment on the continent, primarily through intermediaries, as I mentioned. We've invested in fund of funds, we've invested in funds. We've also recently now established partnerships with financial institutions across the continent. We're also supporting numerous networks on the continent that are bringing together entrepreneurs to share ideas and create value. And finally, we've also obviously supported consulting businesses that provide talent, placement for SMEs. But I'll pause here for now. Thank you very much.
Okay. All right. Thank you. Good morning, everyone. I'm Akinwande Pierce. I work with GIZ as technical advisor, access to. I work under the Sustainable Economic Development Cluster in GIZ, and essentially what impact investing means for us is it's more about capacity building, it's about technical assistance, and it's about policy reforms. GIZ is not a funding organization, so we're not an impact investor. We don't have that. However, what we focus on is we try to look for those areas that are largely untapped, where impact can be significantly created. And one of those areas that we found was in terms of cluster financing. And we are working with over 50 clusters across Nigeria, over 4,000 MSMEs generally. A lot has been said about what impact investing actually is. Impact investing it goes beyond what just looking at VCs. A lot of impact can actually be made at the quality grassroots level, which is why we're taking the cluster approach. The cluster approach is essentially to help us build support clusters who are able to create the kind of impact that we're all looking for. And in doing that, what we do is, as I mentioned, we do a lot of capacity building. We work with DFIs, development finance institutions. We work with financial institutions, impact investors. We are available. We have this pool of clusters. We are looking for funders, like a lot of people in the room. And I'm so happy to be here among a lot of money. And it's, yes, I mean, we're talking about domestic resources. For me, the only way to actually increase domestic pool, aside from what Ms. Ojo talked about, is for collaborations to happen. Without these collaborations, we will not achieve much. So I think that's one thing I'm going to take away from here. See how I can build the right collaborations here. We have the pool. All we are looking for is you to fund. We will provide the capacity building, whatever technical assistance that is required to support the SMEs that you intend to work with. GIZ is always available to provide those kinds of support. And also at the policy, in terms of policy reform, we engage constantly with key regulators, government, at state level, federal level, to see how we can create those reforms that create the enabling environment. I mean, a lot of what talked about enabling environment. Without the enabling environment, it's going to be difficult for impact initiatives to succeed. And yeah, I can also see SEC is also in the room. We've had some engagements with SEC around crowdfunding, and I'm happy to continue that conversation with Madame over there. So policy reforms, capacity building, technical assistance are very key, and that's what for GIZ. When we talk about impact initiatives, and those are the areas that we look at. Thank you very much.
Okay, thank you for the introductions. So let me start with you, Andrew. All right, you spoke about the work you do with rural SMEs. So how do you go about identifying commercially viable and sustainable models when evaluating these SMEs? And based on your experience, what are some of the challenges that hinder these SMEs from accessing the capital they require to scale?
Sure. So maybe just to clarify something, we do not necessarily invest directly in SMEs. We invest in intermediaries that can invest in SMEs. So right now, within the access to finance area, we have five focus areas, but I'll focus on two that I lead. That is local financial institutions and local fund managers. So when we look at, for example, at local fund managers that are setting up their first-time funds or second-time funds, right? We then look at their strategy in terms of, and we know when you develop a strategy and you implement, there can be changes. Very rarely do you see people have a plan and they follow it exactly, because the world is dynamic, things change, right? But we want to see a commitment to having some inclusion of SMEs that have a rural impact. We don't have a hard and fast rule about it, but if you have, let's say, 20 to 30% minimum allocation to SMEs that have a rural impact, that's for us is a plus. It's not the only thing we look at, but it's a plus. The other thing, obviously, we are keen to catalyze now is more local fund managers, because we believe they understand their local context more. They have better networks within those markets and understand the dynamics at play. So, but it's always challenging for them to set up a fund. So we are looking at how can we be supportive, because ultimately we believe that those that should allocate capital should be the local managers. Yes, we know there's a lot of foreign capital that still flows, but our position is it should flow through local managers and then they invest in the SMEs. So we are supporting that at one hand, but as I said, I think beyond rural impact in SMEs, we also look at, okay, for example, right now everybody seems excited around tech SMEs. But what happens to the brick and mortar SMEs? We think they also need support and need investment. So we want that mix. Yes, we know sometimes the tech SMEs can give you super high growth, but the brick and mortar SMEs are the ones that are the backbone of our economy. And we also want to see that sort of inclusion in that portfolio. So these are some of the things we look at when we evaluate fund managers or financial institutions. For financial institutions specifically, we want them to lend more in terms of working capital facilities to SMEs. Because I've been on the other side as a fund manager where we've invested equity in companies, making the assumption that as they scale, they can easily get working capital from the banks, and it doesn't happen. There are lessons we are learning in this regard, but I don't want to pick on banks right now, but so I'll move beyond that. But I think we try to tackle the structural issues that they face, like collateral, interest rates, etc. And at the same time, sometimes we know SMEs also need TA support. They need to improve their governance, they need to improve their internal controls, they need to have better financial management systems. And we would partner with other stakeholders, because one thing we know, for example, there's a lot of players in this ecosystem, and we are very big on collaboration. So when we come in, we find out, okay, who are the TA providers? We can provide this support, let somebody else do the other areas, and ultimately we have a holistic package that works for everyone. Thank you.
Okay, thank you very much. So you spoke on some of the supports that you provide to these SMEs at times. So let me pivot to you, Akinwande. You spoke about capacity development with the SMEs that you work with through the SEDIN program. So what are some of the what are some of the ways in which you help to bridge the gap between where these SMEs are when you meet them and where they need to be for investors to feel confident enough to back them with, whether that be investment, equity investments, or debt, etc.?
Okay, thank you. So, for an SME to be able to attract any form of capital, they need to appear appealing to the financial institutions. And what we found out was that a lot of MSMEs are in different stages of their businesses, in their businesses. So we came up with entrepreneurship program. It's modular in nature. It's called the Inspire ICSS. Inspire, create, start and Inspire, create, start and scale program. And the whole idea is to identify SMEs at every stage of their that they are, and see how we can take them to the next level. So for at the start and scale stages, that's where you find most times they're able to actually attract some of these investments. So why we do this essentially is to de-risk them. The whole idea is to de-risk MSME financing, and also to build investor confidence that if I put my money in this SME, I'm sure I'm going to get the returns that I require. And of course, most of the investors are not directly in contact with the SME, so that's why we try to always come in between and see how we can work at the local level, work with local intermediaries, and to see how we can pull them together. I mean, we've tried a lot of strategies in the past, and that's why we came up with the whole idea of cluster financing, which we think is a good way to actually get across to MSMs.
Okay, thank you. Let me come to you, Adesoa. I think one thing that Tosin hammered on towards the end of her presentation was the need for return amidst the focus on social and environmental returns from a sustainable investment standpoint. So in terms of, you mentioned during your introduction that female entrepreneurs get less than 2% of the available investment capital here in Africa. But at the same time, research shows that, female entrepreneurs generate almost 3 times more returns per, dollar investments compared to their male counterparts. So bearing that in mind, why do you think, why do you think it is that female entrepreneurs still get so little of the available capital? And what can be done to scale, investments in female-backed, female-led businesses?
Yeah, so a fantastic question, and I can talk all day about it, so I'll try and summarize. But it's really, there are some kind of inherent systemic issues in the industry that limit the amount of funding that female entrepreneurs are getting. One of them is obvious, where we don't have enough women as capital allocators. We don't have enough women driving investment decisions. So at Arua Capital, we actually do research every year where we, across Africa, we map out the female-led and female-managed funds on the continent, both VC and private equity. And when we started the research in 2019, there were less than 10 funds on the whole of the African continent that had successfully reached a final close that were female-led or female-managed. Fast forward to 2024, and we've gone up a little bit. It's now 39 funds, but you can just see that we still have a long way to go in terms of the imbalance between the people that are actually allocating capital and driving investment decisions. Because we've seen that when you have female fund managers and when you have women in investment decision-making roles, they're 3 times more likely to invest in a female entrepreneur and 2 times more likely to invest in a female-led CEO, as female CEO. So that trickle-down effect is quite important. And until we have more women allocating capital, my personal view is we'll continue to see these very, very harrowing statistics. Another more subtle one, I think, is just people invest in people they look like. People invest in people they can relate with. So there is a kind of unconscious bias when you have a woman entering the room and she's confronted with 5 men doing a pitch. It's very subtle, but we've also noticed it, and I've noticed it when I was raising my fund and raising my own capital as a female entrepreneur, where these unconscious biases, again, are very hard to break if we don't have more representation of women in those pitch rooms, in that bank when you're looking to get a loan for your SME. So there's some systemic issues within the industry that need to change. And then I think it's also just kind of, there is a construct and a way that we've been told people should pitch, for example, or we've been told people should present their businesses. Men and women are different. Women might prefer just to have a chat rather than be confronted with this panel of judges. So I think we have to be amenable in our approaches to make it more conducive to the difference in personalities of women and men. So as people design their gender lens investing strategies, and as people design how they want to invest in women, we also need to be innovative in how we think about our approach, given the difference in men and women. So I think until you're intentional and actually thinking about some of the obvious, but also the more subtle barriers, we'll also continue to have some of these issues. But as you correctly said, women are known to be better managers of capital. Sorry, men. We are more prudent. We are more. We don't oversell. We don't overpromise. So that statistic is completely right. I think it was Boston Consulting Group that showed that for every dollar invested in a female entrepreneur or female-led business, you're seeing 2.5 times more revenue than their male counterparts. So we need to harness that, and we need to make sure that we're investing in more entrepreneurs that are female-led entrepreneurs, female-founded businesses, so that we, when we're talking about impact investing, we can really show that it goes hand in hand with commercial returns, because that's the only way that it's going to be scalable. That's the only way it's going to be sustainable. So yes, women need to really be at the forefront, in my opinion, of this conversation.
Okay, rightly said. Okay, so let me come to you, Andrew. So how do you measure the success of impact initiatives that you implement, and to what extent do these successes play a role in mobilizing additional capital to drive additional impact initiatives going forward?
Sure. So we might measure success in a couple of ways. I think one of the main ways we measure success is sustainability, like Adesua has mentioned, because as much as our capital is flexible and is very patient, we know that our role is just to catalyze initiatives, fund managers, solutions, right? At the end of the day, for it to scale, it requires more commercial capital. And commercial capital focuses on returns. So whatever we support, we want to ensure that there's that pathway to sustainability that will attract commercial capital. So beyond our support, when we exit, what happens next? Is it scaled? Is it sustainable? So those are two ways we measure success. Scalability from commercial capital flowing in, and also it being sustainable on its own. We also obviously measure success even coming in. How much are we able to leverage others to follow us? So, for instance, a big theme we have this year is local capital mobilization. Earlier, they spoke about pension funds and pension capital. And we're having discussions across the continent as to ways to unlock pension capital for this asset class. When I mean asset class, PEVC. So in Ghana, we're supporting an initiative there that is seeing a fund of funds being set up that is going to have 70% allocation from pension fund managers. We've started a similar discussion now in Zambia and Uganda. So Nigeria, we want to do something, so we're waiting to hear from the pension fund managers what will make them comfortable to allocate more capital to the asset class. We're not saying put 95% to the asset class, like somebody mentioned. No, just 5% of your AUM. And then that's like dipping your toes, right? Dip your toes, see how it goes. Even if worst case scenario, you don't do well, it wouldn't affect your entire performance of your AUM, right? So these are ways we measure success. What happens beyond our support, and also to trickle down the rural impact. That's the other key area for us. A lot of the work we do, at the end of the day, we want to see how does that impact rural communities. Thank you.
Okay, thanks, Andrew. Let me come to you, Akinwande, off the back of, something that Andrew said, which is the conversations that you have with the PFAs and the capital allocators. So, and which is a big part of what you do in terms of connecting, rural SMEs to capital allocators, right? So as you have these conversations, how do you balance the, short-term investment returns needs of the capital allocators you're speaking with the longer-term horizon of the environmental and social initiatives that you're trying to implement?
Okay, happy to answer that. I would say the first thing would be to get the SMEs to be able to even navigate the requirements. Navigate the requirements of the capital allocators and improve their bankability, which is a major challenge in Nigeria, and that's what most of all the support that we provide. That is what it aims to do. As I mentioned earlier, it's basically to de-risk them. So why should I invest in this SME? And if the SME is able to actually navigate those requirements and you are able to provide some level of funding, then you see that helps to build the relationship between the capital allocator and the SME. And so those are basically the area that we focus on. And more recently, we are also trying to see how we can use grants to also help speed up this process. So particularly in the area of climate action, we're also engaging with our colleague sister company, the International Climate Initiative, which is the EK grant, small grants. Very soon we'll also be launching that here in Nigeria, and it's the whole idea is to use these grants like Mr. Dinuga earlier said, as concessional funding. So concessional funding, so they can that exposes them to the development finance institution that we're working with, to other products of the bank, so that can help them to, it can help to continue to build and sustain the SME sector, particularly for those involved in climate action activities. Yeah.
Okay, thank you. And on that, let me come to you finally, Adeswa. And then, driving these initiatives, whether that be across, improving the gender capital allocation balance or the work you do with SMEs, to what extent does the government play a role in, ensuring the success of sustainable initiatives?
Yeah, so I think the government plays a role in a number of ways. It's being able to create the enabling environment for these SMEs to thrive and for them to be able to succeed. We have a number of SMEs that now, access to credit, access to bank loans with interest rates at 35%. It's not very sustainable for growth. There are also a number of businesses that are, whether they're local manufacturers and engaging in import substitution. There's things that can be done around, import duties for finished goods that could, encourage local manufacturers to produce more. There's initiatives that can be done within agri-processing. There's initiatives that can be done in climate and health and healthcare. So I think the government plays a very, very huge role. And actually in Lagos State now, they're putting together an industrialization policy So I would, invite everyone in the room that is actively allocating capital to, provide your inputs there. There's also a taxation bill on capital gains tax coming for fund managers. So I would also say that, we should be putting our voice to the government so that we don't have, these flows leaving Nigeria as well. So around taxation, around enabling environment, around how we support our local manufacturers, there's a lot that the government can do to just, make sure that these SMEs have a fighting chance to survive in what is a very difficult operating environment.
Okay, thank you. And thank you to the panelists for a very engaging discussion. So at this point, are we able to take a few questions from the audience? Okay, so we'll take some questions from the audience now, if any. Any women who want to further buttress Adesua's very...
Thank you very much for an insightful discussion. The discussion has actually been very robust. Now, the gentleman in the middle, I remembered your name. It just went away now. I'm sorry. Andrew. God bless you. Mr. Andrew mentioned regulatory challenges around setting up a fund. By fund managers, new fund by fund managers. And I wonder if they have provided more insight, because the essence of the commission being in this gathering today is to actually harness the activities, the impact or the activities that PE and VC funds have, which we know is huge in this country, and that most of it's below the radar, So radar of the regulator. So the question to us is, what are the impediments and how do we come in, given the robust framework that is already in place? Thank you.
All right, thank you.
Thank you very much for that question. I think my comment was challenges generally that first-time fund managers face, so which we are trying to tackle. But if I attempt to answer your question around regulation, I think what we see now is a lot of emerging fund managers, I think, and Adesua can maybe best speak on this. When you're raising your first fund, you have to raise a really smaller fund, maybe $10 million. And even at $10 million, you struggle. And LPs out there prefer Mauritius still for various reasons, taxation and other costs. But it's very expensive to set up in Mauritius also. And as a $10 million fund, the percentages of your fund administration cost become relatively large for that fund. So what I would say, I think other markets in Africa are adopting more fund-friendly policies to be able to do local domiciliation of funds. Rwanda is doing it now. I think Ghana are doing it. So I think the regulators don't need to reinvent the wheel. They just need to look at what's happening in other parts of the continent and see what can they do to sort of support local domiciliation. But the key challenges, I think, are tax, number one, and then just but the other challenge I see also is even if the regulator makes it friendly, there are no experienced fund administrators also locally. So then you may have the policy, you may have the systems, but then from a fund administrator, that skill set is also lacking. But it can be learned. I think it takes time, but we have to start somewhere. But I'll let Adesua also comment on this.
Yeah, so we've tried to set up a local fund. We actually did that in 2018. And I think that there are a couple of issues that we encountered. One is and I'm not, I think SEC is doing a very, very fantastic job. But one of the issues is just the time to get the license. If you are going by yourself to SEC today to get a license, you're probably not going to get it out before 18 months. our experience was a bit different. So maybe I'm praying that the approval process is much better now. But back then, our lawyer said, don't even bother trying to get it out. It's from 12 to 18 months. So that speed of approval and getting your documents through the system is something that would be very appreciated. And then it's not only just the speed of approval, but just the weight of the documents. I think some of the questions were, getting a signed letter in hard copy from previous employers from like 15 years ago. It just some of it just is also a little bit yeah. So I think maybe some of those things can be looked at as well, just to make it a bit of a smoother process for fund managers. Like Andrew said, our costs are very, when you're raising your first fund, every penny matters. Your management fee is barely covering team salaries. So if you now need to do DHL to London or to America to get an employer's reference, a soft copy should be okay. Just things like that. The frictions of setting up a fund as well.
Let me add before you respond, so thank you very much, Alicia and Andrew. So let me add a few more. So when it comes to what is within control SEC, there's also costs. There's the license and the cost of the registration of that issue, which can be FT. When and you have to pay it upfront, whether you have raised a penny or you have not raised a penny, you have to pay it upfront. So that's one. Then the way the fund system is all set up in Nigeria, you have to bring in a lot of parties, which is additional cost. Like in Mauritius and other places, one fund administrator will sort out all of the issues. Yeah, you have to have a custodian, you have to have a trustee, then you have to have solicitor, an issuing house. And by the time you gather everything and registrar, by the time you gather everything in a PE model that you are trying to gauge the cost structure, it becomes very, very, difficult. So maybe some of these things can be relooked for, PE and VC funds. For example, most PE and VC managers can probably be their issuing house if they want to file their application, because the entire document will be prepared by them anyways in terms of the investment strategy and everything. But even when you have all of that, you still have to go and bring a party and all of that. So maybe some of those things can be looked at.
If it's done on a percentage of your AUM, that would be much better rather than just a flat fee depending on who you are. If it's done on a percentage of your AUM, then at least if you are 10 million, 5 million, 20 million, the cost of the registration on the license is applicable for your size.
Exactly. So thank you very much for the responses received. So regarding the procedure for licensing, it has actually been improved. It has been enhanced. Like you said earlier, that it will take up to 18 months for the fund manager to.
Back then, not now.
Exactly. So I'm saying that you can get your licensing in 3 months. Now, why 3 months? It's because you will need to go through the rudiments of the training and the registration process. However, when your licensing registration is being delayed, mostly it's not at the end of the regulator, but rather in your documentation, in filing with the SEC, because the requirements are clear. So one of the requirements is to ensure that there is no gap in your CV. Now, is to ensure that we have fit and proper status of all the operators that are operating in this space, because we need to ensure that confidence is maintained in this market. Yeah. So another issue about electronic documentation, has also been resolved. We collect electronic documentation. We do electronic processing. So all of that has put into place, has reduced the licensing procedure to a large extent. Okay, so please get your license. Then around the cost of issuance. So what the commission did around cost of issuance is to allow you to register large sizes. I'm going to speak about later, I think. To large size funds by way of shelf registration. Now, the shelf registration, it's just a fee. It's just a filing fee, a certain file. It's a small amount filing fee, actually. Do you understand? So, but when you issue your tranches, then you will be able to pay the authorization fee based on the size of the tranche on issuance. So it solves a lot of issues around that place. And we expect to see participation, really, because I get so heartbroken when I had the extent of the activities going on, the impact financing taking place, the SMEs being financed, and all the technical assistance provided to prepare them for credit accessing and financing. And I'm like, where is the SEC in the whole of this process? And to me, this is a takeaway. Thank you so much.
Any more? Okay.
All right, thank you. My name is Ayodele Olojede from Wema Bank. I have a question that borders on perspective that was shared by Andrew. And I think Adesua, when you talked about interest rate at 35% not being sustainable. Andrew, you know, you're being very professional when you said you're not going to name some banks. But I know very categorically that Wema Bank will not be one of those banks. Or I dare you to name. Okay, so whilst I acknowledge some of the challenges that you talked about, I think it's also very important and imperative that we also begin to look at financial institutions that are really very committed to supporting SMEs. It's not as if the challenges when it comes to talking about access to finance is not there, but there are some things that are being done intentionally. So when Adesua was talking about the interest rate, 35%, she's correct because of the type of capital that the bank, uses to support or facilitate lending. And that's one of the reasons why Wema Bank is always at the forefront of having conversations, very practical conversations like this, because we need to be able to get that funding. We need to get into those partnerships that would help us to really be able to bring down that pricing to be able to support and facilitate more lending. When I was earlier on, when I was also giving the goodwill message, I touched on a couple of things that the bank has done, the gender lens financing, and how the bank has also been able to give concessionary pricing. And this has nothing to do with any support coming from either a DFI or any impact investor. It's just a commitment or a social responsibility on the part of the bank to be able to do more, for female-led businesses. And it's collateral free. Because I heard you also talk about, there are collateral requirement, but this is something that we've been very conscious of. And it's interesting to also find that, some of the insight around how safe it is to lend to women, it's reflecting even in the portfolio, and that continues to encourage us to do more. Wema Bank today is facilitating the funding support under the Nigerian Office of Philanthropy and Impact Investment for $200 million. We took on that project, an initiative on our own to even be able to build a platform. And what it is that we're trying to say, which is exciting for me, based on the theme for today, catalyzing impactful investments in Nigeria. We're at the forefront of driving conversations like this. And this particular initiative is one where we're asking all Nigerians to make donations as low as 2,000 naira or $2 to be able to build up funds to support SMEs in some highlighted segment, and 50% to be able to go to women. I'm very excited, just listening to all that we're talking about here today. It's even very more exciting for me that a financial institution, Andrew, this is for you, that a financial institution is at the forefront of facilitating that conversation, at the forefront of trying to be able to galvanize and rally funding to be able to help and support SMEs. So talk to the right financial institution and things can move forward better. Thank you.
Thank you so much. Any question from the online? Because I have a question over here. Please.
Thank you very much. Wonderful panel session. I have like 3 questions. My name is Yinkade Tuber from Bass Capital. I have 3 questions that need clarification, and my questions are coming from the lens of risk and return. As an investment banker, usually a tug of war speaking to the buy side to fund investments. And what we've noticed is that there is a depth of catalytic investment for early stage entrepreneurs. Most PE and impact investors like to invest in companies that have some operational history. Why is that a phenomenon in Nigeria? Is it from the point of risk or from the point of return? I don't know if I should take my the other questions together. Secondly, we also noticed that even PEs that are investing in operational companies, what we've noticed is that they like to do debt funding. And when they come with equity and term sheets, you notice that those term sheets are rather cutthroat, and you'll be wondering the solicitors that did the term sheet for the PEs. Is it also from the perspective of risk or from the perspective of return? And then lastly, we've also noticed in the sell side that impact investors and PEs, what they do, they like to invest in tech-enabled business models. Even though we've noticed that there isn't adequate research to back that tech-enabled business models perform better than the quote-unquote brick-and-mortar business models. Why is there such preference, and why, even when the investment is going into tech-enabled business model, why is there concentration in fintech, edtech, and agri-tech with little sprinkles in looking at the entire industry value chain? Thank you very much.
Sure. So I think your first question was about, remind me again, sorry?
Lack of catalytic investment in early stage entrepreneurs.
Okay, why do investors ask for operating history and not invest in greenfield projects? So I think for all 3 of your questions, it's really dependent on the investor. Different investors have different investment mandates. So you might have a business that is, has no operating history and is a greenfield business that's very attractive to one investor, but not attractive to another investor because they have a different fund mandate. So yeah, I would say that's the answer to the first one. The second one was about debt, that most investors are structuring their term sheets like debt. So I think if you look at, there's 2 things. If you look at the fund returns in Africa as a continent over the last 10 years, it's less than net 5%. So when you see investors structuring debt-like features into their term sheets, it's a way to mitigate against currency risk, because we've seen that there's been a lot of fluctuation of currencies, especially in Nigeria, Ghana. So those kind of coupon or income-like features in the term sheet is to mitigate against currency risk. And then you might see that investors might have either liquidation premiums or redemption features, and have some sort of self-liquidating features in the term sheets, which are kind of debt-like more than equity-like. And again, I think it's because we haven't had a very robust exit environment. So we don't have, like the US have, a very vibrant IPO market. We don't have a vibrant IPO market here. We pray that more multinationals buy our businesses, and we have a number of trade sales, but we haven't really seen a lot of trade sales happen. Instead, we've seen multinationals leave Nigeria. So because of that lack of depth in the exit market as well, that's why you'll see a lot of private equity investors structuring debt-like features, self-liquidating features into their term sheets. And then your last question again, sectoral preference is very much, again, a factor of the investor's mandate. You do have funds like Arua, for example, that invest in brick and mortar. We've invested in a number of local manufacturers that don't have any tech enablement. So it really depends on the investor that you speak to, whether they have a strong preference for tech or not, and which sectors that they're focused on. But yes, you're right, fintech has had a very strong bias. Healthcare has also had a very strong bias. Consumer has also had a very strong bias. But it's really, where do investors believe that they're going to make the best bang for their buck? And that's how they design their own investment strategy and their own investment mandates.
Thank you very much. I think there's a question from the online participants. I would like to ask the person to come online and ask the question. And the person on mute?
Yes.
All right, thank you.
Sorry, is it a bit loud?
Yeah, go ahead.
Okay. Thank you. So I'm working on a project in Spain with South African sovereign wealth funds. And we're looking at how sovereign wealth funds can power development and impact investments at the local level, but also attract global investment through de-risking blended finance. So I'm just wondering whether you have experience with sovereign wealth funds and if you see their potential role as significant in this space. Thank you.
Thank you very much. Did you get the question? I think we can, Mr. Akinwande maybe can take a jab at it. It's speaking about sovereign wealth fund. Sovereign wealth fund. If whether any one of you have considered engaging sovereign wealth fund who actually have available funding for SME investing.
I think definitely sovereign wealth funds can play a significant role in the ecosystems. I think in Senegal, for example, they have a sovereign wealth fund that's setting up a fund of funds in collaboration with KFW to support first-time female fund managers. That's something we've seen. In other markets, I think, like any other fund, they do allocate some of their AUM to impact or vehicles or impact sort of initiatives. So they definitely can play a role. I think, but at the end of the day, they're also looking for returns. So as much as they can come into, and as you mentioned, a blended finance structure, it will be interesting to understand who's coming with the concessionary capital. Is it the sovereign wealth fund or other players? But definitely they can play a role.
Thank you so much. A round of applause for our panelists. Thank you so much. We'll move straight to the next activity on the agenda. This is a presentation which, if you all recall, my CEO, Mr. Temore Glover, actually hinted on it. The title of the presentation is Study on Africa as a Jurisdiction for Domiciliation of Investment Vehicles. This report was sponsored by Mastercard Foundation and MEDA, and it will be presented by Ms. Gwen Abiola Oloke, CEO, DI Africa. Please a round of applause for her.
Good morning, everybody, and thank you for staying back. I think my name is Gwen Abiola Oloke, DI Africa. I'm representing the collaborative for the advocacy for domiciliation of funds in Africa. And I think the first panel helped to open this conversation. And I must specially recognize Madam Rabi Meidawa from the SEC. She came all the way from Abuja just to be part of this conversation. Thank you very much for coming. So the background to this study, and without even throwing data at you, we do know that everybody says Africa is the next frontier, So despite the uniqueness of Africa, when I say uniqueness, they call it risk. In those days, they used to call it the black box. But today, it's no longer the box. It's the attraction of, every savvy investor. Despite the flow of capital to Africa, we still find that a lot of these funds are domiciled outside Africa. And the conversation is, if Africa is good for investments, why is it not good for hosting your funds? And then we began to have this critical conversation. And then MasterCard was magnanimous to look at a study. MasterCard Foundation have been very, very pivotal in investments in Africa, especially around the SMEs. Of course, with partnerships with other development partners. And capital is key to development in any economy, and Africa in particular. And so we're looking at how do we catalyze impactful investments in Africa, unlocking the opportunities. One of the ways is the flow of capital. And not just any kind of capital, appropriate capital, which today we think domestic capital is the most appropriate. That's because we can hedge or mitigate or avoid foreign exchange risk. I think Tosin talked about the returns, sustainable returns. One of the things that threatens returns in Africa is the volatility of foreign currency, either the liquidity, or the availability, or the the value, the change in evaluation. So I just want to give you. So this study was carried out by a consortium funded by MasterCard and MEDA. The consortium headed by Momento. So I'll just go straight into the presentation. Please give me a slide. So we took a few countries in Africa to see, and countries of high potential because we had spoken with stakeholders to see where are the countries that have, seemingly, most of this flow of capital comes first from perception. You have a perception about a jurisdiction, then you decide to investigate that jurisdiction. The perception may come from maybe studies, may come from word of mouth, may come from so many sources. And then you begin to investigate that jurisdiction to see if it's attractive or if it's conducive for your fund and domiciliation. So you can scan this so that you can have copies of this right on your phone. And so we took about 13 countries in Africa, Nigeria inclusive, Mauritius, Rwanda, Uganda, Kenya, South Africa, Cote d'Ivoire, Togo, Senegal, Cape Verde, and a few other countries to see what the jurisdictions looked like, what is the potential that they have. And then also we compared them with international jurisdictions that existed that were seemingly more attractive to than Africa. And of course, we had some stakeholders within all of these countries, and categorized into investors, fund managers, regulators, professional service providers. And some of you were here. I must first of all also acknowledge members of that stakeholder panel in Nigeria. We had SEC, we had Banwo Igodalo, we had Acumen, they're not here. We had Sahel. We had a few of the fund managers that are here, Aroa Capital. Let's go to the next slide. And we began to look at what makes a jurisdiction attractive. In those countries that have succeeded, based on data, statistics, and interviews from fund managers, what was driving that success? What influenced that success? And then this is just a summary of what we found out. So establishing a legal home base for funds, that's what domiciliation is all about. We try to define it. in a stable and transparent environment for investment. So there's something around stability, there's something about transparency, either in the rule of law or whatever requires, the investor requires within that jurisdiction. And for mobilizing, we also realize that fund domiciliation is also another catalyst for mobilizing capital within that jurisdiction, either international capital or local capital, but at least different kinds of capital. We found that countries that had, somebody talked about Mauritius. Mauritius is a good and a widely acknowledged fund domiciliation jurisdiction. That in itself began to flow capital into that jurisdiction. So domiciliation also unlocks domestic and foreign capital. We found that out. We also found out that domiciliation increased domestic capital flows, and it unlocks fit-for-purpose capital for local investment vehicles. When you have high domiciliations, you also have access to capital for SMEs. I mean, that's given. When you have SME growth also, then you have productivity, you have contribution to the economy, and then you have job creation. So it's just a cascade of impact, all starting from domiciliation. Now in Nigeria, for example, we have local domicile funds that the conventional banks, their funds are domiciled here. The development banks, their funds are domiciled. Now imagine a scenario where those capital providers, those pockets of capital, are not in Nigeria, and all you had was foreign capital. You can just take, you can imagine that. So let's go to the next slide. Now, the overall strategy for dissemination of this study is really to have this kind of roundtable conversations to create the awareness. I think sometimes an advocacy starts when there's an awareness of a gap. The SME conversation started just a few decades ago. SMEs have always been in Africa. There's always been capital, the same kind of capital. But once that conversation started, the same thing with gender lens. People would say, oh, it became sexy, and then people started talking about it. But that awareness begins to motivate and begins to galvanize people, resources, towards meeting or solving that problem. Now, it also galvanizes policymakers, and that's why we have people like SEC here. We have some of the professional capital allocators here. We have Veritas Glanville, a pension fund here as well, institutional investors. And then we can demonstrate success by addressing this financial gap. So this is really why we are disseminating this report. And the essence is to see how really we can take this from just these roundtables into the marketplace with the right partners on board, with the right consistency of the conversation, and we can begin to get some sustainable results. Next slide, please. Now we looked at the maturity scale. Really, what that means is how mature is a jurisdiction. I think the maturity also facilitates or influences the level of attractiveness of that jurisdiction. So we looked at the regulatory framework of the jurisdiction, the judicial framework, operational efficiency, and enabling environment. From our study, we found out that these are some of the parameters that influence the flow of capital, and then the domiciliation of the capital. Capital can flow for business, but does that capital domicile in that jurisdiction? These are some of the things that, some of the parameters that are paramount. Of course, there are so many others. And then in these findings, we just did this kind of heat map across Africa. If you look at the green side, it shows the most mature markets and moves down to the red side. So we found out that Mauritius is the most mature market in Africa. And of course, that also speaks to the volumes and the data. The report has all of your data, so this is just a summary. South Africa is next. Then you have Rwanda. People will wonder, Rwanda that has just started. If you get into the full report, you can understand why Rwanda is on the path to the green side. Then you have Morocco, you have Ghana, and then you have Nigeria. Uganda is in the middle. Cabo Verde is also there. Kenya, Cote d'Ivoire, Togo, Senegal, Ethiopia. This is the result of what we found in the market. Now, when you look at the regulatory framework, so there were ratings done against each of these jurisdictions based on this framework. And the respondents also gave feedback from which we came up with this summary. Under the regulatory environment, of course, Rwanda is at the top. Mauritius is at the top. You have Rwanda, you have South Africa, you have Ghana, Uganda, Morocco, Nigeria. And you have Kenya, Cote d'Ivoire, Senegal, Togo, Ethiopia. Now, if you take a guess at some of these countries, you can understand why some of them are top at the regulatory and why some are at the bottom at the regulatory. Now, under the judiciary, you have South Africa, you have, Mauritius again. They are topping all the rates. You have South Africa, you have Ghana, Rwanda, you have Togo, Ghana, Morocco, and you still have Nigeria in the yellow flag. You have Kenya, you have Cabo Verde, you have Cote d'Ivoire, Senegal, and Ethiopia lagging behind. Under operational efficiency, you have Mauritius, you have South Africa, you have Nigeria, Ghana, Rwanda, just like that. At the bottom, you have Ethiopia again. Under enabling environment, you have Mauritius, South Africa, Rwanda, Morocco, Kenya and Uganda that time, Ghana, Cabo Verde and Nigeria, still at the yellow space, and then Togo, and then you have Ethiopia at the end. So this can actually explain to you why capital flows to Mauritius. They top all the parameters that are, important to investors, determining whether they domicile their funds in the jurisdiction or not. Next slide, please. Then what are we try to look at the opportunities. So the slide before this was the status quo. We try to look at opportunities that some of these countries have. Mauritius is an established domicile and are the top choice for fund domicile because of its regulatory framework and operational efficiency. We could see that. There were some parameters that we had also for each of these arriving at the framework. Then high potential jurisdictions, we found that these countries, Cabo Verde, Ghana, Rwanda. Now, Nigeria was actually in this area for high potential, but at the time of this study, Nigeria was under the FATF list. So that disqualified Nigeria in a lot of ways. And investors, they want to see if the countries that are compliant with global standards or not. So it's very important that regulators begin to see how they monitor. They don't always have to wait till there's an inspection before they begin to see how compliance is going within. But I think we've gone far now to get ourselves out of that list. So this is what really knocked Nigeria off. And this is a report that is global. I mean, there's been a lot of interest on this report. And I believe that investors will begin to take decisions. If they're beginning to look at Africa, they begin to take decisions based on what this study has done. Now, countries that have high potential for domestic capital mobilization: Kenya, Morocco, Nigeria, Ethiopia, South Africa, Ghana. And some of these countries are at the bottom of all the parameters. For example, Ethiopia. Nigeria is on the yellow list. Do we go or do we not go? You can either go to red or green, depending on how you move in the next 2 years. So we have a good chance. And then there are some countries that we saw that had some regional collaboration that they could strengthen and make them, stronger voice within this conversation. Cote d'Ivoire, Senegal, and Togo. Because these countries have the same regulators, banking regulators, financial market regulators, money market regulators. So really, standing alone may not be very useful. And they're relatively smaller economies. Next slide. Now, so these are specific recommendations for Nigeria. This is a whole lot, but I will just go through some of it in summary. Now, the essence of this study is to help Africa, particularly these countries of high potential, to begin to see areas of weaknesses, benchmark against international and best practice, and how they can refine their policies to begin to push them into the attractiveness bar. So Nigeria, for the overall recommendations, there was a need to get Nigeria to galvanize. Nigeria has a huge, somebody talked about 25 trillion local pension funds. That is just one sector. I mean, if you put together the gap in financing, it's far below that. So the pension sector alone, not to talk about the banks, can finance this. But what's the intentionality about pulling that finance within the space in Nigeria? So how do we mobilize? When they talked about grassroots, the retail capital that is available, we hear of people, all these Ponzi schemes. We hear of people losing billions to companies that don't even have fixed addresses. If those people that are not structured can mobilize capital, that means there's a potential within. Yeah, it's very funny. But Nigeria is one of the hardest hit when it comes to Ponzi schemes. So there's a lot of what I call idle cash in the informal sector. How do we mobilize that? That may be a low-hanging fruit. So this comes to the regulators. What are we doing about enabling, mobilizing crowdfunding? How are we making these regulations more adaptable? You know, these guys who are at that level, they don't really care about all this big documentation. But they understand crowdfunding very well. Communal living has always been with us in Africa. Esusu has always been with us. That is crowdfunding. They understand it. Get them into the room and let them put that policy together, and they hold themselves accountable. That is one way. But if we sit down outside their sphere and we put those policies together, it's not going to mobilize capital. They will continue to put, money must go on an errand, I always tell people. So people want to use their funds, but how do they use it? We have the diaspora. They really want to come back home and invest. They want to invest in their communities. They want vehicles that are small, manageable. Imagine if you have 50 vehicles in a village. People can manage and mobilize capital within their hamlets. They can monitor projects that are being sponsored. Imagine having clusters of that across Africa, across Nigeria. I don't need to move my funds from here to Borno State. Those guys in Borno State who understand the vagaries of their environment, they can invest. They can pull capital together as long as the vehicle is structured, is regulated, but regulated in a way that allows them to exit and get in and get out. So I think we're calling on the regulators. So it's not just institutional capital that is a potential for Nigeria. I think that the retail capital is the strongest potential that we have today because people understand that. And that's one way, a very clear way of making financial inclusion, really, really accelerated. So there's opportunity in the real estate for institutional investors. So there's so many opportunities in Nigeria we can have for mobilizing capital. We have international capital come to Nigeria and take advantage of our real estate space. If Nigeria is not attractive, they won't be here. Some of them only domicile the funds here because it's a regulation. But how do we now mobilize the local capital to take advantage of that same opportunity that this international capital is looking at? So they've promote infrastructure investment that will encourage, so regulatory environment we talked about, double taxation is in Nigeria, so clear the tax environment. Also look at challenges that are related with currency volatility and availability. We also look at the judicial framework. Somebody talked about the rule of law here. And I think that saga that happened between this man and, it's really made it just hit Nigeria below the belt. So the judicial framework is also very important. Now, there's also something about the regulators working in silos. When you want a process that requires multiple regulation, regulator A says something, regulator B says something different. So how do we harmonize regulation in such a way that is seamless, in such a way that is aimed at achieving an outcome that the sector players want to achieve. The next slide, please. I think that's the last slide for us. We also talked about the operational efficiency, cost of doing business in Nigeria. You know, these are some things that needs to be looked at. So it's a holistic approach, enabling environment, volatility of the environment, cost of redress, regional integration. So these are some of the things, and we have, of course, the implementation partners for some of these policies that we looked at. So we believe that Nigeria has a strong potential. Nigeria has the capital, Nigeria has the people, Nigeria has the knowledge. In the study, we actually found that Nigeria was one of the most sophisticated financial markets, not just in Africa, but globally. We're saying to some international players that we spoke to that on our phone, in terms of foreign exchange transfer, I can transfer money from my phone to any bank in the world. True or false? A lot of them didn't believe it. Is that possible? I said, yes. So Nigeria is very advanced in certain areas, but there are also some areas that are lagging behind, which is not allowing this domiciliation attractiveness, increase. Thank you very much for your attention. I don't know if you have any questions for us. Yeah.
Thank you so much.
Yeah.
No, I think just is Madam. We move to the panel discussion. So moving straight into the panel discussion, actually talking, calling on other industry experts to buttress more on the point that she has also raised with her presentation. Joining her on stage is Mrs. Rabi Maidawa from Security and Exchange Commission, Nigeria. Please a round of applause. She has felt the most attacked today. Exactly. Please, let's go easy on her. A round of applause for her. Don't worry, madam, you are in safe hands. Also inviting Mr. Bonaventure Okaimo from Development Bank of Nigeria. Please, a round of applause for him. Also joining them on the stage is Mr. Oluleye Ademola from Veritas Grand Views Pensions. I'm sure all the while he has been listening about the pension funds. I would like to actually mention, sir, that I was informed that today you must make commitment. And then last but not the least, joining them on the stage is Miss Ayodele Adeyemi Faboya from Bawan Igodalo. Thank you so much, madam.
Thank you very much. And welcome, panelists. I've introduced myself, so I would like the members of the panel to give themselves full introduction. And all right, I'll start from Ayodele, please.
Harnessing capital in Nigeria. We've advised quite a number of the private equity and infrastructure funds in Nigeria in relation to setup and also in relation to investments and divestments. And I'd say that One of the areas that we do pride ourselves in, and that's one of the things that we'll discuss as we go along, is our ability to structure. I think structuring is a key issue in relation to harnessing capital, and that's one of the things that we've always tried to do as a law firm. Thank you. And in relation to commitments, we commit to be available to assist you.
We also engage in financial advisory, pension advisory services. You know, the way we guide, especially those that are about to retire, on how to, you know, spend their retirement, how to prepare for retirement, and to ensure that we're still able to maintain, you know, certain level of well-being after retirement, so that we don't just retire and begin to, you know, live in penury, so to speak. So that is really what we do. But in ensuring in doing this, we ensure that one, capital is preserved. If you give us 1 million, we try as much as possible to keep that without losing. And at the same time, we also have to rate as a way of positive return. For us, capital preservation is not just give me 1 million, then I turn 1 million to you. What's the value of that 1 million? Because if you give me 1 million 2 years ago, it won't be same. It won't have the same value if I'm giving you back to. So that has to do with, you know, adding value to, you know, whatever assets we manage, and at the same time we ensure that we remain liquid in terms of when there's a need for us to meet our obligation as a pension fund administrator. We ensure that we don't tell stories, so that if there's any need for anybody to assess part of, you know, is our RSA balance, whether retirement or, you know, now that we have equity contribution for mortgage or, you know, loss of job, we ensure that we don't tell stories. Once we have your application, we make sure you are paid, and of course, you continue to live your life. So basically, that's what we do as a pension fund administrator. Thank you.
Good afternoon, everyone. My name is Ayodele Ojoshipe, and I head business development at DBN. The Development Bank of Nigeria was set up about 2014 in partnership with some foreign development organizations like the European Investment Bank, African Development Bank, the World Bank, KFW, AFD, and the likes, basically to do three things: provide access to funding for MSMEs, de-risk lending to MSMEs, such that banks and other institutions that are funding businesses can be more comfortable to provide that funding. Then thirdly is to do capacity building and technical assistance. So the TAs go to the banks and the financing partners, whilst the MSMEs are trained on building their businesses. For us, impact is about what we are. We focus on impact in everything we do. So once we disburse the funds, we want to see what is the impact that this fund went to. So impact for us is about making financial inclusion real in underserved business segments and sectors, like gender financing, access to funding for youth, startups, first-time borrowers, and all of that. So for us, we'll keep doing that, and that'll be our commitment. Thank you.
So my name is Rabi Maidawa. I work with the Securities and Exchange Commission. I head the Funds Authorization Division, and I'm also sitting for the Head of Investment Management Services Department. Now, in the Investment Management Services Department, we oversee the framework on collective investment schemes and ensure the implementation of the framework in line with the Commission's mandate of investor protection and capital market development. So my presence here, like I said, is to go back with feedback because, as earlier mentioned, the framework on alternative investment scheme is robust. And we know that there is a lot of impact financing that has been taking place within our space, particularly in the private equity and venture capital space. Like the partner has in Banwo and Eguadalo mentioned, they do a lot of financial engineering that do not come to us, and we are aware of it. So it's important for us to be part of this discussions, particularly with the report that Gwen also mentioned about the regulatory framework and environment and impediments in those areas. We really want to go out of the yellow portion of that report to remain in the green. You see, in the regulatory framework, we are just light green. So we really want to go out of that and go back to other places. We also know that another impediment is, like we've been discussing on our table, it's the judicial process, which is around dispute resolution mechanism. And the Commission, it's championing a workshop and seminars to members of the judiciary. And the essence of that is to see the need to come out with industry-based judicial mechanism that will drive or remove the bottlenecks in dispute resolutions and will enhance the country's domiciliation of investment as an attractive country of investment. So thank you.
Thank you very much. And so let's go straight to the question. I think the essence of this panel is to see how we can slightly deep dive coming from that study. And so this conversation is not based on, it's just based on data, based on a study, based on a report, based on feedback from the entire ecosystem, internationally and locally. And so we want this conversation to actually get into actionable conclusions that can be moved forward and really put Nigeria at the attractiveness priority for funds. So let me start with SEC. Once again, I want to thank you for your presence here. And really, I want to extend my gratitude also to the DJ. I think our new DJ of SEC is very innovative in his thinking. Yeah, so we must acknowledge that. SEC was very involved in this study, so that shows that there's some willingness to always move forward. So, Madam, for what regulatory reforms? We just talked about, even before this panel, the panel before talked about some of those bottlenecks. And then you did respond that things have changed. So maybe this is an opportunity for you to, what regulatory changes or reforms have happened that really can move Nigeria to the green bar for attractiveness for fund mobilization? Because if you, I don't have the data here, but if you look at the data, the amount of opportunities in Nigeria far outstrips most of Africa. So really, if Nigeria has the right regulation and the right environment, perhaps they can really champion fund domiciliation in Africa. So that question is to you, Madam. Yeah.
Thank you very much, Ma. It's a very good question because it's something that has been at the forefront of the Commission's policy development, because we really want, like I said, to develop this space. When the Commission developed the framework for alternative investment schemes, which was done in 2013 with some amendments to it, we noticed that the takeoff of PE funds and private equity and venture capital funds has been very slow. Particularly, we have, in fact, PEs have been a little bit active with assets under management of about 50 billion, 50.2 billion. But yes, Naira, not dollars, Naira. But for the VCs, we have, since the inception of that framework, we have only registered one fund. And as we are speaking today, that fund had not properly taken off. And it gives us a concern because this is a fund we have registered like 2 years ago, and it has not properly taken off its operation. So that makes us to look inward and ask ourselves, what do we need to tweak in our regulatory framework that will make Nigeria actually an attractive investment vehicle? And in doing that, like I started discussing earlier, we have talked of the structure of offering of the funds. You know, we mentioned, because there are issues around cost of issuance, which is related to the fund size. And the Commission had, we have proposed, you know, as a department, we have proposed a rule around in our alternative investment framework for private equity, venture capital, infrastructure funds, and specialized funds. You know, the opportunity, the ability to register, like I said, large sizes by way of shelf, and issue them in bits and pieces, in tranches. Now, this will reduce the cost of issuance, and it will also enhance the time to market of these offers. Because one of the bottlenecks have also been the delay in the processing period, as well as the documentation. And also, talking about the documentation, we've also come up with a DEEM approval process. Now, the DEEM approval process throws back the responsibility of compliance and disclosure back to the initiators of the fund, because the Commission is not involved in the merit regulation. So we send it back to the developers, to the fund managers, the responsibility for ensuring that proper disclosures are made, and that the risks, which is also a very important aspect of our work in protecting investors, the risks factors are being properly disclosed, and they take responsibilities for any misrepresentation. So that, if you could do that and get the legal and get an affidavit to sign saying that you have complied with that provision, we assure you we can give you your approval in 5 days. Because in what we do, what normally delays, like I said, it's around the issue of documentation. And the Commission used to look at things like crossing your T's and dotting your I's. So now when we send back with the DEEM approval process, we send it back to you. So when I say you, I mean fund managers, pardon me. So it means that if your documentation, it's not up to standard, the risks, it's not back to the regulator. Do you understand? So we've put that in place. Then also, in the mode of issuance, we notice that even when we register these funds, particularly the private equity funds, we notice that the success rate is not very, very high, you know, and we've tweaked that provision, that framework, to allow for funds to be offered not just on payments in full on application basis, but that, like I said, when you could come at a commitment-based fund, and drawdowns could only be at intervals when it's needed. That way, it will enhance the success of the fund. Another framework or incentive that the Commission had also consider to drive this process is to also open up the market for foreign funds participation. Now, our rules on foreign funds permits foreign funds not domiciled in Nigeria to offer a class of their shares to investors in Nigeria using a SEC-registered representative. That way, it will deepen our market and it will also enhance foreign investors or even our local galvanized domestic investment in foreign securities or funds. Then, of course, in Gwen's presentation, she had talked about the real estate sector that is yet to be developed. Another incentive that the Commission had worked with in collaboration with stakeholders and the Federal Ministry of Finance is to get the pass-through status for funds and REITs and the Finance Act of 2021. Now, this accorded the funds a pass-through process in the sense that the funds are not charged income tax at the company or fund level, but as such taxes are pushed down to individual investors' income tax rates. Now, this makes REITs more attractive, and it also enhances the development of the real estate sector in the country. So these are some of the initiatives that the Commission had put in place to make Nigeria a very attractive and domicile investment vehicle, to also deepen the space given the pool of funds that we have. Because the concern, we've talked about a lot of pension funds, and we've just see a minute portion of that funds in the capital market, and that has been a concern. So for us, we are pushing it back to the fund managers. It's about your structure, it's about your innovation abilities, also about the returns, like it's been stated in the sustainable returns. Thank you.
Very much. Thank you very much. I think you said a whole lot. I mean, I think what I could pick that was key was the issue of turnaround time, the issue of costs, especially with the shelf registration. And most importantly, the last thing you mentioned was about the REIT, because that real estate sector is one very vibrant sector. Looking even at the gap in that sector, and that's really an area that people understand real estate investment in Nigeria traditionally. And so the taxation in that fund structure also should be attractive. I think maybe what is lacking is the ability to communicate this to really the users. If some of them were not in this room, they would not even be aware, that this, because when we did the study, we found that there were so many things that had changed, and that indeed Nigeria was better than some other jurisdiction, but that's not the experience that the users have. So thank you very much, Rabi. Thank you very much. So let's go to our development bank here. We'll put you on the spot a little bit. You talked about your role, and the good thing is you are an example of a locally domiciled fund. I guess maybe by regulation, maybe if not by regulation, given the antecedents of many of your investors, international investors, they'll probably have asked for domiciliation elsewhere. So that brings me to the fact that regulation is important sometimes in driving. And in South Africa, for example, we found that there's a regulation that if you're going to have access to local funds, then you must domicile that fund vehicle in South Africa. So that is something. So I want to ask you, I know that you walk through intermediary financial institutions. So what role really do you play in de-risking this investment? Because really, somebody talked about de-risking the sector, de-risking that really makes You can also de-risk an environment, not just the businesses. So what role do you have as a DFI in de-risking the two questions in one place? In de-risking your investments to mobilize domestic capital? Because we also looked about collaboration in funding. So you are funding in collaboration maybe with a local bank or a local financial institution. Then secondly, how do you work with regulators to ensure that, maybe you answer the first question first, okay? Let me let you answer the first question, all right?
All right, thank you very much. I think I agree very well with what has been said, that a key focus for investors is returns. But what is one thing they're worried about is the risk. It's the risk of our environment. The macros are very, very tight. A lot of things are changing rapidly. So there's a lot of worry. And when we are in those meetings trying to raise funds, you hear a lot of questions. You have to justify and explain and let them know, look, this thing is sustainable. So what we have done, what works for DBN is this. So there are different models for different DFIs. There are DFIs that are retail DFIs, but we are a wholesale DFI. What does that mean? It means that we do not go directly to the MSME to fund them. We fund through those we call our participating financial institutions. These are banks, deposit money banks, microfinance banks, financial institutions, and other mortgage banks that we have taken through our due diligence process, a very, very tight process, to ensure that these guys have the right levels of corporate governance, they have the right levels of systems checks within themselves in place, and that they meet certain ratios. Because in doing all of this, the regulation must also be upheld. So they meet the regulatory ratios, and that they have processes and systems that really support MSMEs. And when they've gone through that, they are formally onboarded as partners to DBN. It is then that we can now disburse through them to the end beneficiaries. And I think that is what has been working for us. So I mentioned that we were floated in 2014, but we actually got our license to operate as a wholesale bank in 2017. And from then till now, till today, we've disbursed over over 1 trillion naira to over 700,000 MSMEs. And that's something I think we got right. And out of that fund, out of this disbursement, 75% actually went to gender-based businesses. 75% by volume. So it's something that we focus on deliberately when it comes to achieving impact. Now, in terms of de-risking, so we have a wholly owned subsidiary known as the Impact Credit Guarantee Limited, fully owned by the DBN. All they do is provide guarantees to catalyze lending to MSMEs. So there are financial institutions that would ordinarily want to require, say, 100% or 150% collateral. But having spoken with ICGL, they're able to take on certain transactions either on individual basis or portfolio basis and fund those transactions that they would have ordinarily not funded because of collateral inadequacy. So that's another way that DFIs can really de-risk the lending and support investors in coming in to support our impact areas. And this we've done also for some years now. We've issued guarantees of about 248 billion naira to different financial institutions. And of course, we pay claims as well. Aside this, I think one very important thing is also the focus on capacity building for MSMEs. We are very deliberate about that because you have to also ensure that the end beneficiaries that are getting these funds, right, have the right models in place, the right systems in place, the right structures in place, or even if they didn't, you are growing them on an ongoing basis to get to that point, like registering their businesses, their bookkeeping, having the right practices, and measuring their income from capital and not mixing everything up. So these are things that we do deliberately. And beyond that, we also try to ensure that we push them in expanding their market, because access to market is also very important. So by way of import substitution financing, to ensure that they can now even start to export. Aside that, another thing we do is technical assistance to the PFIs themselves. These are the banks. So we have what we call a community of practice. Because beyond just working with the big banks, right, we have a lot of microfinance banks that are also financing the real micro businesses across the country. We have a responsibility to ensure that our funds get to every nook and cranny of the country. So we have a community of practice where all of these microfinance banks are put together and we discuss issues in the industry and help to advocate for changes in those areas. They also share corporate governance practices amongst themselves, and it's a table to learn and adopt what others are doing. And we pick some of them, like I think we did in 2023. We didn't do it last year. I think we're doing it this year. We work with some of them and sit with them. We appoint a consultant to check their systems, their processes, their products. Where are the gaps? And these consultants work with them to fill these gaps, to block these gaps. And we end those sessions with an immersion visit in a country of choice. So we took 10 MFBs to Kenya in 2023 just to understand how funding for real micro and small MSMEs is optimized. Because we know Kenya is a good example because of the ease of payment they have there. And some of those MFBs have come back, to float products and services that have now really gone to the real micro and small businesses. So these are a couple of the things we do. And in terms of technical assistance, we also do it on an ongoing basis. For instance, now we have a fund from the World Bank which is strictly focused on livestock because the opportunities are enormous. Enormous. And the whole idea is that that fund, if well channeled and monitored over time, we're not saying it will happen overnight, over time would reduce farmer-herder clashes and all the issues we're seeing, particularly in the north and also spreading to the south now, and drive social cohesion. So part of what we are doing is, look, this is a new focus area, right? How do we ensure that we generate the right level of knowledge, we create the right level of awareness to ensure that funding can move into this sector? Because it's one thing for the fund to be available, it's another thing for the banks to be willing to access that fund to fund that area. So we're not just funding it, we're also de-risking it. We have our guarantees through our ICGL. They can guarantee up to 75% of the fund so that whoever is funding it is comfortable that whilst I'm securing myself, if anything goes bad, right, I'll be covered. So I think I'll pause here. Thank you.
Yeah, thank you very much. There are quite a number of key learnings there, but I just want to highlight one or two things, inferences. So I see where an investment vehicle or a fund manager is benchmarked or benchmarking its practices, best practice, global best practice, and then can make itself attractive for investors. Okay, so this goes to the fund managers. They've covered risk management, they've covered governance, not only at their level, even at the level of the beneficiaries, downlines. And so when you have that, I think the investors, and even if you're a locally domiciled fund, the investors can see some comfort in that vehicle and see that, okay, well, they can at least take some of their funds into that vehicle. So thank you very much. Maybe if we have this kind of practices within other local funds, other local vehicles, and share this information, share this practice, share these learnings, so that even the smaller fund managers can see how they can position themselves. Even though they are domiciled here, then they can attract capital because some of these things have been covered. I think you've covered risk, you've covered governance, you've covered viability of the businesses that's based on your due diligence process. So I can see a lot of things that create the attractiveness. Thank you very much for that. So I go to a big pension fund manager. We can't talk about domestic capital without the pension funds. All of a sudden you woke up and just mobilize everybody's sweat in Nigeria. People work for 20 years and you just keep their money. So we want to ask you, Mr. Ayodele, we do understand that, there's a lot of pressure for pension funds to mobilize capital. And we have statistics that at least 65% of the pension funds is in low-priced government instruments. And where you were talking about returns, so they are higher returns. So what can be more incentive for you to look at alternative investments? Or I can also ask the question. I don't want to look at challenges. You can come up with so many things, but what incentives can really attract pooled capital from you into the alternative investments, where really there is a cap in the capital? Thank you very much.
Thank you, Ma. Let me start by saying that we are not where we used to be in terms of investment in alternative investment. Years back, if you look at the asset allocation of pension fund administrator as prescribed by our regulator, PENCOM, federal government securities, then money market, maybe we have some state government security. But over the years, this has changed, and that's why today we have infrastructure funds. We have allocation to infrastructure fund, even though we don't have it in all our funds. We only have it in Fund 1 and Fund 2 because looking at Fund 3, Fund 4, they look, might say that they are a bit conservative because we are talking of people that are about to retire and, of course, people that have retired. So we don't want to subject them to, some level of volatility that might come with, variable investment income. But if you look at the other time, the size was given that as of December 2024, the AUM of the industry stood at 22.5 trillion. But of course, the bulk of the fund, which is Fund 2, which is the default fund that anybody today, if you are onboarded, that's where you fall into, or else you opt for Fund 1, or when you reach age 50, then you move to Fund 3, only has 5% allocation to, P, 5% to infrastructure fund. And of course, for us, we've been trying to, see how this can be, expanded in such a way that people in Fund 3 also can also be part of of course, that might come with a smaller, percentage. That's one way. But for us as a company, when we are talking of how do we, invest in alternative investment, the first thing we look at is the issue of, we want to, the other time, the issue of adaptive, regulation was mentioned. So we are not just looking at, having robust regulation. We also want to be able to adapt to, the regulator. That's talking of the regulator now. They need to, flow with the trend of things so that we're able to, put in place the proper, and adequate regulation in place. Then the issue of oversight is not just, yes, this fund manager has come to the market to raise money. We also expect that there be some sort of a follow-up after the yes, I know SEC, I know they have this as part of their oversight function, but we believe that we need to also ensure that this we are there to it strictly, because we are talking of managing people's future in terms of the assets we manage. So we don't want anything to go wrong. Like I mentioned the other time, even from our own side of regulation, I mean the PENCOM, then there might be need for increasing the percentage a little bit, and inclusion of like Fund 3. Of course, that will also help mobilization of funds to that the alternative investment. Then another thing we look out for is the issue of structure or corporate governance. For us, a company is as good as the people managing it. That. So when we are looking at a particular fund manager, I want to see who are the people behind it, who are the people running it, what is that pedigree, what is their track record like, even though we have all this in regulation, but of course we also need to ensure that we check all this. So for a fund manager with quality, corporate governance, of course, very easy to mobilize, fund. And we have seen this happen. If you look at infrastructure fund in the market today, there's a particular fund manager that has raised money like, up to 8 times coming to, the market because as a result of, the kind of, corporate governance they put in place. At the same time, as, fund manager, we also want to see the quality of the investment committee and at the same time the advisory committee, because all these speak to, the kind of return, the kind of investment they're going to be taking. Then the issue of quality of the assets is very key. How bankable are these, assets? That is very, very, important. And for some investment, in order for, the fund manager to mobilize fund, there might be some level of comfort, which may come like a form of a guarantee. So that is also one of the things we believe that can also help in mobilizing more funds to, alternative investment. I don't want to stress the issue of setup costs anymore, because this has a way of impacting on what we get at the end of the day have return. So lastly, I think the issue of return is very germane, because at the end of the day, what we give to our RSA holder is return. So we also, as much as we want to do impact investment, at the same time, the issue of return we give to our RSA holder is very important. Thank you.
Thank you very much. I think the fund managers, you were ticking the boxes. There's no difference between what the local investor is looking at, what the international investor is looking at. So thank you very much. We're taking notes. And lastly, for lack of time, the professional service provider, Mr. Ayodele, please, how can service providers really help to increase confidence of investors and making Nigeria attractive for foreign fund domiciliation? Yeah, thank you.
I think in speaking about service providers, because you have the whole gamut, the custodians, the lawyers, everybody, I think, first of all, I would focus on the fund managers. I think that the fund managers have a very, very big role to play in harnessing that investor confidence and bringing that capital in. The first thing I would say is that the fund managers have a duty to engage. And you see that there has been growth with the SEC. A lot of that growth doesn't just come about by sitting down and saying that these structures are not in place. You know what the investors, you know what the capital providers are looking for. We've talked about the challenges ad nauseum, right? It's clear what the issues are. For instance, in going around trying to market and working with some of our clients, trying to market some of the funds, you hear the PE funds say, the PFAs saying, oh, we're worried about certainty of exit. How have you structured your fund to give comfort around that? Yes, I hear the conversation that the structures we have in place or some of the processes we have in place provide some form of difficulty in that. But I would urge fund managers in the room today to understand that the SEC, whilst it does have its challenges, is interested in growing the market, and that's something that I have realized over time in working with the SEC. You just have to engage. You have to ask for your structure. I'm very glad about the fact that infrastructure funds have been mentioned a number of times, on this panel. And I'll give an example. The first SEC registered infrastructure fund is the ARM Harris Fund, and we advised on that fund. At the time, the infrastructure fund rules were not in place. So it required engagement. This is something that is different. It is not a PE fund per se. You cannot register it or regulate it in the way you would regulate a typical PE fund. And that engagement was done back and forth, but the SEC got the message and was able to register that fund. And it was only after that the infrastructure fund rules actually came out. But why do we have more infrastructure funds right now that are raising capital, attracting PFA funds? It's because that engagement was there in the development of the infrastructure fund rules. And so I want to charge fund managers that you have a duty to engage. And we have so many examples of funds that we have advised where engagement happened. I'd give an example of a fund where at the time they started, also an infrastructure fund, the PFAs would require a certain number of years of expertise for infrastructure funds, but we didn't have fund managers that had infrastructure fund experience. And this was going to the SEC to say, we need to register this type of fund. We don't have a fund manager with that experience, but we need to show it because we need PFA capital. And the solution then was to say, look, second, so partner with a fund manager that exists that doesn't have the experience, and second people that have the experience into that fund manager until you get to the point where you can register a fund management entity that has this experience. So those kinds of things can happen. And when you do that, you build the trust, you build the confidence of this asset classes. I think another thing to look at is to, of course, the reporting, communication, transparency, it goes without saying, right? And I think that many funds have begun to look at those areas more and more. And the fact that it's important to be transparent. You have a risk management framework, you have your governance framework, you have your internal audit framework. You actually, it's one thing to have them in place. It's another thing to be transparent about them such that your investors are confident, and are able to then bring that capital to you. And one thing in looking at those frameworks and looking at transparency that a lot of fund managers need to consider is oversight, independent oversight. For instance, and this may not be for everyone, but it's something to consider. For instance, you find that most PE funds, your typical investment committee is comprised of the fund manager because they have the investment experience. But we found that funds who have an additional layer of independent review. So yes, the investment committee has overall responsibility for approving investments, but before it comes to the investment committee, particularly for specialized investments, you do have some funds that have an independent, like an AFC, come in and review those opportunities. You find that those funds tend to have repeat investments because the investors are confident that there is that independent oversight. It's not just the fund manager. We have another eye that is looking at these investments for us and making sure that we're comfortable. And I think that's something that in interacting with a few pension funds has been a big plus for pension funds when they are investing. Another thing is to build capacity and educate. A lot of capital providers are not investing because they don't understand. And that was a big issue with pension funds at a time. You say pension funds are not investing in PEs, they're not investing in infrastructure. At the time, they were not investing because they did not understand. There is the need for stakeholders, for the service providers to go out, to engage, to explain your structure, and to get them to understand that structure and bring them on board, rather than just say that they are not engaging. Another thing I would raise would be the need for service providers to integrate and to come together. We all talk about Mauritius and how seamless the process is, and the fact that we don't have the fund administration experience in Nigeria. That's actually not true. We do have the fund administration experience in Nigeria. The problem is it is scattered, it is fragmented. You then have to get a lawyer, you get an auditor, you get a consultant, and there's no integration of that process. That is what Mauritius has been able to do that we haven't gotten yet. And so there needs to be a deliberate process by the service providers to integrate those services so that you're almost providing a one-stop shop. There is a seamless flow of the provision of those services between fund manager, between lawyers, amongst the custodians, amongst everyone, so that you're providing that seamlessness that the investors are enjoying in more mature jurisdictions. I know you're looking at me, so I'll stop there. But I'll stop there because of time.
Thank you very much. Thank you so much. Yeah, so we come to the end of, so questions but one key thing that I just want to highlight something. She talked about integration of service providers. Maybe I can just chip this into SEC. Maybe you can have a way to pre-qualify integrated service providers for the fund management industry and find a way to, would I say subsidize? especially for early stage. It doesn't have to be subsidy, but I mean, but if you have a process where people can, a consortium of advisors can come together as a unit, you know, and it's available to fund managers. Some of these decisions made by fund managers is coming from ignorance of half information or lack of knowledge. Okay, thank you very much. So questions from the, yeah. Thank you, Chairman.
Thank you, Madam. My name is Frank Aibogu. I'm chairman of IIF, but my real work is as publisher of Business Day. When I get into this kind of sessions, I find quite often that there is a lot that is happening about which very little is known out there by the people that we seek to impact. Firstly, SEC, I think that the regime at SEC today is probably the most market-facing of all since I have been a journalist, and I have been for a while. And I think that's good that you are here. I don't know how they managed to get you here, but it is not often that you have people from SEC like you at this kind of gatherings. And I think this is just a testament of what's changing at SEC. But there is, well, thank you, Madam. There is a lot more, given what you have heard today, that we must begin to do. And I am commending your willingness to start to take this forward. For my friend from DBN, it's amazing. Disbursement, you say, is about $1 trillion. That can bring down a whole state if you were to put the money all over the place. But very little of that is known. There is so much. I belong to a number of platforms, and all people say is about the difficulties in Nigeria. But there are also moves to ease that difficulty by people like DBN and others. And I think there has to be a creative way of telling this story. For instance, 1 trillion naira disbursed, I would imagine, to hundreds of thousands of small-scale businesses. That's a lot of impact. Very significant impact, given that if you mention DBN to an average Nigerian, he will ask you, who's DBN? So I think we need to continue these conversations, but we need to go on to take more actions, more steps. But more importantly, I think we need to find a way of telling our story better, to give hope to people that if they have not been impacted yet, it is coming. Thank you very much. Thank you. This is great for me. It's inspiring. Thank you.
Thank you so much.
Thank you very much for that, sir. And I mean, you are very apt. A lot of people don't know DBN, and the reason is because we more like stay at the back most times and allow the banks and the financiers to have that engagement whilst providing the liquidity. In some cases, it's deliberate, but we allow our partners choose. Ayo is here from Wema. They put it on their offers, DBN funding. Some banks don't want to do that because they say people would think it's a national cake, right? So, but again, very, very good point and well taken. We are also looking at strategies to ensure that we're more out there, part of the reason we're here, and also that we co-create products with our PFIs such that the end beneficiary knows that, look, this funding is coming at a much more reduced rate. The livestock I mentioned, we're giving it at between 9 to 10%, and we capped the end rate that the PFIs cannot give it out at more than 7%. So if we give it at 10, yeah, you can give us 17. If you get that, you can give us 16. So that way, more customers will start to know that there is a financing entity at the back. Thank you.
Thank you. I want to ask a question and maybe make one or two comments. And I think it's a stupid question. When we talk about domiciliation, are we talking of naira or dollars? Because in my own mind, there's a lot of naira here. So if we say it's not domiciled here, are we talking of in terms of from a funding point of view? So I just wanted to get that clarification.
Okay, so when I would just try and make it very elementary so anybody can understand. When you talk about fund domiciliation, so a fund is a vehicle, an investment vehicle. It could be denominated in any currency. But in Nigeria, I would suppose it would be in naira. Even the funds come in dollars, like for DBN, they are international investors or other fund managers. It will be exchanged and disbursed in naira. So that fund will be registered in Nigeria. All funds are registered. That's part of the regulation. Otherwise, investors will not invest. So be registered as an entity in a jurisdiction. So in this case, we're saying rather than register it in Mauritius or Cape Verde or Cayman Islands or any of those places, register it in Nigeria like a bank, like DBN, like the pension funds, and disburse the funds from there. So if you're disbursing in Nigeria, for example, you'll be disbursing in local currency. Now we have fund managers who are Nigerian origin, but they've registered the fund outside. Not just fund manager, financial institutions, Flutterwave, all of these companies. They're not registered in Nigeria, the fund itself. They're registered. So Nigeria does not get the tax benefits and all of those kind of benefits that come with the fund. For example, when I went to Rwanda on this study, I found that a lot of Nigerian companies, tech companies, are registered in Rwanda. Why? Because they perceive Rwanda is a more transparent jurisdiction. It's easy to enter Rwanda and you meet a minister in 2 days, things like that. So perception is important, and I think the engagement, like the service provider talked about, I think SEC, I'm so glad that they came here at very short notice, 2 days notice, and the DG second, she's top in SEC. In fact, the fund managers here, you are very privileged to meet. If I were you, I would not leave her. She approves all the funds in Nigeria. So what I'm saying is the willingness, like Dr. Frank said, of SEC to be here to have this conversation. We are starting an advocacy. We are starting the journey. Yeah. I hope I have clarified your point.
Yes.
Okay. Thank you very much.
Thank you. Yes. So I think there are two issues in that regard, which is domiciliation in Nigeria and the currency of domiciliation, right? It's been said that one of the greatest sins in finance is financing development with dollars or another currency. So even if I domicile it here and it's in foreign currency, I think partner at Sahel spoke about, even if I'm investing in a company and I make 3x, but then the depreciation is 4x, I'm behind, right? So are we trying to get domiciliation in Nigeria, or are we trying to encourage the local currency funding? Just trying to look at the two sides of that.
So it's both. Let me tell you why the domiciliation is important. So when funds are domiciled here, there will be an arrangement with the central bank. This is what happens today. To make a conversion, there may be a forward sale. At the point of exit, they can take their funds back. Okay? But a lot of times, these funds that are outside the radar, like a SEC officer said, they have other ways that they have those conversions done. So at the point of exit, sometimes there are problems in taking the funds. But now, the more dollars comes in here and is domiciled here, then liquidity is improved. You understand? So not only do we have an issue of mitigating volatility, or the advantage of mitigating volatility, even the liquidity of foreign currency improves. So at the point of exit, we will not have these gambles and currency volatility. At least it will not eliminate it, but it will reduce it.
So we need to get this done very urgently, right?
Very urgently.
Yeah.
This conversation is really apt. Yeah.
Both of you, do you have any comments? Do you have any comments?
Thank you. And just in addition to that point, because at some point I was getting confused as well, the difference between
domiciliation and, let's say, local mobilization of capital with regards to currency. And I just wanted to, I work in an impact fund, and we are, I think, on the spectrum of things, very, very impact. And in structuring smart and innovative financing solutions for, the companies that we support here, and we deploy USD. But we do that understanding and acknowledging that there's an FX problem here. We've had portfolio companies that have literally almost gone bust, and just because of that depreciation that has happened, not just in Nigeria, across the continent. But one of the things we have been thinking about is, and this came to my mind when you mentioned arrangements with CBN, because some people can come and say, we know what has happened in the last few years, backlogs, the airlines trying to leave, and some other companies trying to repatriate capital, even with the CCI, and they just can't get the liquidity. But I think everyone has to understand the role that they should play in this impact ecosystem or spectrum of capital provision. And in the recent funds, and by the way, I work for Acumen Fund and I lead investments for them in West Africa. When we have been structuring recently, 18 months, 24 months, funds and vehicles to attack the poverty problems that we're trying to solve in the continent, is so figuring out, okay, you're trying to catalyze money in crowding capital, to be honest, mostly USD, but we know that at the end of the day, that will blow up a fully impact-focused, let's say, renewable energy company providing energy access in Kotongora or Guzo up north, because those cash flows are, one, coming in slowly, and there will be a lot of defaults because those people are poor. So what we are trying to do now is bake in hedging solutions where on the day of disbursement, and they take different forms and shapes, you either agree a fixed rate where, okay, when you're paying back this money, if it's working capital or some form of debt or so, it is benchmarked to that rate. Over a period of time, you pay back what the exchange rate is. But then you're thinking, who now bears the cost of the depreciation, right? So there are market players like TCX, MFX, I don't know who has engaged with them here, but those guys will also charge you for the cost of hedging. So that's where I think a role we are trying to play, and also trying to encourage maybe DFIs and even other foundations, family office-backed impact organizations to play, where you provide either TA, that's how in our minds we can smartly deploy TA, or grant funding, where, okay, we're saying we can come into this structuring and we're going to use TA to fund the cost of hedging. So you are fully hedged and you don't have to worry about the depreciation because you have to keep topping up or whatever that cost is to TCX. Recently we announced an investment in Malawi through our Hardest to Reach fund, where we deployed this type of structure. We deployed capital into an energy access, female-led founded organization, and then brought in TCX to structure the hedge, and then worked with the EU through Get Invest to provide a grant funding for the cost of that hedging solution. So it was just a thought that came to my mind around how you can still be fully hedged without necessarily having to deal with, with all due respect, by the way, all the bureaucracy that comes with maybe having to deal with the central bank in Nigeria, for example. But yeah, thank you.
All right. Thank you so much to our panelists. Please, a round of applause. Okay.
Well, not respond, but to Madam Rabi, because we have her in the room, and I think that certain things need to be said, and said very loud and clear. And she has said she's taking back, she's taking our feedback. We've spoken about, regulation and all of that, and you did mention the RECOs, the real estate investment companies, and the tax pass-through status. But you would note that looking at the real estate investment schemes, real estate investment companies, we still don't have the scale that we would have expected. Now, the issue is regulation. and how we regulate. And I think that's important for the SEC to begin to regulate on a risk-based basis. So how do you register funds? It's not a one-size-fits-all approach. There are certain funds that should have different criteria, different processes. There are certain types of smaller funds that should be registered within days. Their information requirements should be reduced. And I think that that is the thing that is going to push us. You know, that's the push we need, where the SEC now begins to divide based on risk and to begin to register and regulate based on risk profile. That is very key. Another thing I wanted to speak to was the conversations around dispute resolution. And it's really fantastic. I hear you when you say that those conversations have started to happen with the judiciary. But I think that the SEC often overlooks what it has in the IST. There is a limit to what we can do with the judiciary. You can engage, but it's not within our control in this room. What is within our control in this room is the IST. And so I think the SEC needs to look at how to revamp the IST and how to bring the IST to a point where we can now begin to use the tool of the IST for dispute resolution when it comes to capital market matters. And that's something I know that the CAC has started to look at in terms of companies with the committee. There's this committee that is being set up where they can then begin to adjudicate on certain issues and lift that stress where you say, oh, dispute resolution is an issue. So those two things I thought very key to point out to you. Great work that has already been going on, but we need to push, and we need to push now.
Thank you so much. Madam, you want to make a comment? Okay.
1 minute. Thank you so much. These are very good suggestions. You've all made very good suggestions, even around the hedging provision, that it's quite insightful, because it's to me, when the pension fund says they are not bankable, that the instruments are not bankable, when I have a structure like this as a pension fund, I will rush for it. Yes, it's a bankable investment. Then thank you for your insight. And indeed, these are the kind of things we require. The chairman have said we just stay in the background, we don't make noise. The regulator is always very docile, you know. But our new DG is market facing, and you see there's presence, and we intend to push it. He has made pronunciations around mark to market, and we have committed to those pronunciations he made. So we will look at all the suggestions you have made, and I'm pushing it back to the fund managers. You know, the commission is not merit-based. You know, it's disclosure-based. So the ingenuity of product development now falls back on the fund managers. You need to really be innovative in your thinking, and also de-risk those products, because where we have issues is the risking, because we have to ensure within our regulatory ambit that the investors, even though in quote, including the pension funds, are qualified investors, are protected, so as to avoid these issues of dispute resolutions in the first place. Thank you so much.
Thank you very much, panelists. Please a round of applause once more for them. As we round up, I would like to take a picture with everyone. And I also have been informed that the doors have been closed, that Madam Rabi is not leaving. Fund managers can get to speak to us. So please, let's a round of applause as we take pictures. Please, Chairman, and also Chizoba and Mr. Gucci, please, let's join for the picture. Miss Alice. Let us also remember that Mrs. Rabi actually said that there's a lot of take backs. So we're going to actually have a meeting with her tomorrow. And Alice. Right. It's a good mix. That will be two men. I think we should have Mrs. Rabi in the center, so that is, no. I mean, center between the both of them. Yes, between the both of them. Yeah. Okay. This is one of those pictures. If we were in the social world, everybody would point to her. As the picture was going on, our chairman was telling her, I'm coming to your office. I'm coming. Right. Thank you so much to our panelists. Please, another round of applause for her, for them, please. Hey, take it easy, madam. Take it. Please, she needs to be saved because this is quite. Please, can you get somebody to fix this up? So sorry, madam, please. We're moving to the roundtable conversations, and this is actually a created roundtable conversation with specific topics and also people leading those roundtables. I think before we start the roundtable, I've been instructed to engage the crowd, please. Please, can we all stand up just to stretch our legs just a little bit, just a few seconds. And I've also been informed to tell the online people to also stand up in their own offices. The only thing that we cannot see them, but we believe they are honest. So let us just kick out our legs just a little bit to let the blood flow. This is what we do in the football training ground. And also in please, let's kick out. Both for that is not the kicking I'm referring to. All right. And then let us try and move our shoulders. Let us move our shoulders. All right, thank you. A round of applause for yourself, please. As we actually get going to, let's sit down. Let's settle down, please. And so the round table, I'll mention the topic and the leaders of each topic. The first topic, which will be led by Mr. Oguche Agoda, the CEO of PENUP, is on policy and stakeholder considerations for local fund domiciliation. And then the second, so as these are leaders of these various topics, they will actually sit on various tables, and so we all are enjoying to join them in the topic that actually best interests you and also the topic that you like to actually lend your voice. I also want to mark that the flip charts we'll see behind will be recording the points that each table makes, because we actually want to put this in a report that will be shared with everyone in this room, because like we mentioned earlier, this event must bring out actionable points as we go forward in impact investing space. It's not just a conversational event. The second topic is fund manager and investor considerations for local fund domiciliation. This will be led by Mr. Bofade Elegbede, Associate Director, Acumen. Please, as I call the name of the leaders, please, can we just wave? And the third, financial infrastructure and banking considerations for local fund domiciliation. This will be led by Ms. Ayodele Olojede, Division Head, Retail and SME, Wema Bank. Please, a wave so that people will see. The next topic is gender lens investing considerations for local fund domiciliation. This will be led by Ms. Amaka Okechukwu, General Partner, Weave Capital. Please, a wave. All right. And then the next topic is tax considerations for local fund domiciliation. This will be led by Ms. Abiola Dabiri, AVP Africa Finance Corporation. Please, a wave. Okay, I think maybe she stepped out of it. Okay. And then the last but not the least, legal and regulatory considerations for local fund domiciliation. This will be led by Ms. Michelle Chikezie, Partner, GLS Law Firm. Thank you so much. All right, so I will enjoin each and every one of us to please convene at the seat or at the table that our various roundtable leaders, and then let us have the conversation. This will actually happen in 30 minutes, so we'll try to actually cover each of the topic in each of the tables. And also for the online people, The online people, Miss Ifeoluwa will be engaging the online team on the same topics. And so at the end of the roundtable, the leaders of the various tables will come out and also address us on what were discussed and also the takeaways. So the conversation will take about 15, 20 minutes, and then the presentation will happen in 10 minutes. So all together, 30 minutes. Thank you so much. Yes. Announcing the topics again. Policy and stakeholder considerations for local fund domiciliation, led by Mr. Oguchi Aguda, CEO PenUp. Where is he? Was sitting over here. And then fund manager and investor considerations for local fund domiciliation, which will be led by Mr. Bo Fade Legbede. Then next topic, financial infrastructure and banking consideration for local fund domiciliation. This will be led by Ms. Ayodele Olojede. And then gender lens investing considerations for local fund domiciliation. This will be led by Ms. Amaka Okechukwu. And then tax considerations for local fund domiciliation. This will be led by Ms. Abiola Dabiri. And then legal and regulatory considerations for local fund domiciliation. This will be led by Ms. Michelle Chikezie. Financial infrastructure and banking considerations for local fund domiciliation.
About 7 highlights that we think, that we believe would help us to really be able to activate this fund domiciliation locally. So the first one was we talked about the importance of having a robust banking services that local funds can even utilize to manage their operations and to be able to facilitate capital flows to MSMEs. And so what do we mean? I'll give the example of lending. There are some financial institutions, if you go in there to ask for loans, it will take weeks, months before you are able to even have access to that loan. So we talked about the option of, you could come up with a digital process that would make lending easy. Within 5 minutes, a loan has already been disbursed. And of course, such platform would also include the one that would not require collateral. It would also leverage credit bureau infrastructure to be able to support programs, automated programs like that. The second point that we highlighted is the use of, yes, domiciled funds can facilitate access to capital. So what about creating product paper, tailored financial product that local funds can, that will facilitate access to such funds. So let me give an example of such product papers. Banks generally have traditional methodologies to assess and grant loans. So when you begin to get very creative, your credit risk team may not be very supportive, but then having access to domiciled funds would help facilitate quick access to getting the loan. And we can come up with programs like revenue-based financing. Revenue-based financing would only focus on your source of cash flow as much as possible in paying back that loan. And then you have the cluster lending programs. And this cluster lending as a program, we discussed it in the context of mobilizing retail capital. When Mrs. Abiola Gwen was speaking, she talked a lot about retail capital being available and as a source of funds that can be harnessed, for funds domiciliation, working with micro entrepreneurs. Cluster lending, I think that's a program that GIZ is running, and even for Wema Bank, in partnership with various organizations, will drive cluster lending to be able to using the ecosystem. So I just want to emphasize here that for this cluster lending program, the bank is not seeking to change the ecosystem the way it operates, but the bank is plugging into the ecosystem on the basis of the understanding of the players to be able to support and harness access to finance. Another point that we talked about is how to encourage investment vehicles. One of such, we talked about the iPhilanthropy platform. The iPhilanthropy platform is a platform that's been designed to be able to drive funds domiciliation amongst Nigerians locally and of course Nigerians in diaspora. It works in a way that we have been able to segment the businesses that we're focused upon. And in fact, before, the truth is, let me say this, I know this is the Wema Bank's program, but the suggestion came from the team, and I only just used this particular platform as an example to be able to illustrate that example. The individual said you could have a business segment like fashion, agri, and then you have investors, indicate which business segment they want to be able to invest in. So what it means is that whether you want to donate to be able to support that particular business segment, or you want to invest in it, relying on some profiling that has already been done by the financial institution, that opportunity exists to be able to harness and support MSMEs. And then, of course, we talked about regulatory framework. How do we begin to work with our regulators to be able to create a supportive regulatory environment that would encourage banks? So what about tax incentives? How can regulators support banks to, to fund MSMEs and then let them know that, look, for every MSMEs that you fund, we'll be able to grant you this amount in tax incentives. Can regulators themselves also even begin to push, education, awareness campaigns on the benefit of investing in MSMEs? On the basis of this regulatory framework program. And partnership, collaboration was also highlighted as an initiative that can also help in activating funds domiciliation. Partnership with, amongst private sector players, partnership even with government, and in this instance to the regulator, and of course private investors to create environment for local fund domiciliation. A lot of examples were given. An example like banks can aggregate or can finance or they can support an investor who can aggregate other fintechs, and then as the fintechs begins to demonstrate viability, they can be bought over and supported to scale. And at the end of it all, we also need to be able to create a framework to measure the social and economic impact of the investment that are made to all of these MSMEs through the domiciled funds. And this is a way to be able to demonstrate the effectiveness of the capital that have been deployed. Thank you very much. Please clap now, clap.
Thank you very much. Please, another round of applause for her. Any addition from your team? Okay, she did a very wonderful job. A+. All right. Sir, Mr. Guche, please. A round of applause as he comes on.
All right. Thank you, Team One. We didn't have as much as 7 or 8 points like they. Right. We just had three points. So our team was looking at policy and stakeholder considerations for local fund domiciliation. So what is it that will make local fund domiciliation become a thing, and how do we expand from a policy point of view? I think there were 3 key things. Number one, it came back to the pension industry. So PenCom and the pension industry needs to be deliberate about really alternative investments, impact investments, and drive that as a strategy. Because until that happens, then even if the PE funds or the infrastructure funds, they want to domicile in Nigeria, and they don't get the pension funds to invest in them, then really is no point. So there has to be that deliberateness from the industry, and especially the regulator in pension industry. So that's one. I think 2 is the creation of a bubble, which is like a financial center. The way it's done right now, we see in Rwanda, in Dubai, and in Mauritius. Once that happens as a country, then it provides the framework for capital to begin to flow and be domiciled in Nigeria. With all the waivers, with everything that happened. So that goes without saying. We need to be deliberate about that. And I know there was talk about Lagos signing something recently, but that talk has been on for a while. So we need to, if you want to ensure that funds are domiciled in Nigeria, we need to create that financial center. Then I think the third and final point was central bank being also deliberate about attracting foreign direct investments the way they do foreign portfolio investments. So foreign portfolio investors know that if they come to Nigeria on day one, they can bring the dollars, get Naira in, enter into some contracts, and on day 365, they can get that money back, and it's fine for them. But not so for foreign direct investors. So if investors want to invest in a fund, they might not get that same leeway, or there's not deliberateness from central bank. So we think that deliberateness has to happen such that people that want to come to Nigeria, invest long-term or invest in funds domiciled in Nigeria can also get that leeway from the central bank. So we think these three things, if we can focus on them from a point of view, we can begin to get more domiciliation of funds in Nigeria. Thank you.
Please a round of applause for him. Up next is Mr. Bo Fadi, speaking on fund manager and investors consideration for local fund domiciliation. Please, while he's speaking, the QR code for feedback for the event will be projected, and also the QR code for registration on to NABI is also placed on each person's table. Please let us all scan, give a feedback, and also join the NABI member. Thank you so much.
Thanks. All right, thanks, Chukwuemeka. So we had, I think, an interesting exchange. Played both. It was argumentative. We aligned on a lot of points, and we also tried to play devil's advocates. We've tried to summarize the discussions in the following points. So I think one question that I think we spent some time on deliberating, and we didn't land on an answer per se, but thought about it was, is it truly intrinsically beneficial to the local real economy and the SMEs that domiciliation happens? So is it domiciliation we are looking for or solving for, or accessibility? And does domiciliation guarantee accessibility? And our view is that I think maybe there's a gap that still has to be bridged somehow. And today we don't know who's going to bridge that. We voted on whose job it is, but we don't want to throw any shades for now. I'm just using PFAs as an example. We've heard the numbers today, how much is sitting locally, but there are some structures that already sort of like come in the way of just guaranteeing that access. Another point that came up was around readiness, like how much engagement has gone on the fund manager side of things, or would I say on the operator side of things with the PFA industry. So how many fund managers have actually gone to the PENCOM websites, downloaded asset allocation guidelines to understand, this 5% that we're talking about, what does it take to unlock it? Do we even know about ratings? How many ratings do we need to get to become investment grade for the PFAs? Because you have to first cross that hurdle for you to even make it to a pipeline discussion in their meetings in the first place. Next is that we have to also understand from a fund manager's standpoint, and in responding to these discussions and thoughts about domiciliation, is that when you think about it in a fundraising standpoint, is that GPs are takers of LP preferences. So a GP, you can think about it that, okay, I want to be a Nigerian, domiciled, founded, private equity, VC, proudly Niger. But the pools of capital that exist today, when you look around your peers, the other guys that have announced first close, second close, who gave them money? So that's how you map it and say, okay, these are the guys interested in emerging markets in West Africa and Nigeria. But you go on the road and they're saying, hey, we can't move money to Nigeria. It has to be in one of these places, either in New York, Luxembourg, Cayman, So there's also that limitation that I think, we'll need to discuss, which takes me to my next point, is that these pockets of capital that, all right, thank you. These pockets of capital in Nigeria, in country, the controllers of these pockets of capital, do they really, truly consider themselves as potential LPs or part of the LP universe? Like, do the fund managers actually expect that every fund manager that's trying to raise money for a fund, should have interacted with him, or he's trying to, duck that discussion? And then, in terms of the gap that now exists here, we now, it led us to another area that, like, what have the local DFIs done? So there's a lot of, in quotes, thankless work, right, beyond investing, that needs to be done by someone. And in this case, it has to be, I think, someone that is somewhat linked to, I think, the public sector. And we landed at the DFIs. We don't want to name names, but they're low-hanging fruits, like, coming up with, it might be local currency, it might be USD as well, but at fund level, first loss guarantees to drive in and incentivize some of these structures that we're trying to promote in-house. By the way, I said that's thankless job. Again, I think we spoke briefly about hedging. Providing hedging solutions, embedded within the way that you're structuring those funds, might also catalyze and drive up interest in this, I think, ambitious target that we have set. Are there any DFIs today that are either funding or providing structures and a platform for emerging fund managers who are interested in setting up and domiciling locally, how to warehouse their funds maybe first close and second close, to again drive that go-to market for them to build momentum? Another point that came up in terms of considerations for this is also the depth of the markets and the instruments that exist today. And there was one case study that came up around how, I think up until maybe 18 months ago, it was okay to to do the back-to-back hedging structures with the commercial banks, where USD comes in, whoever it is that has received that money in terms of a portfolio company, or an SME in this case, keeps that money, basically fixes it with their commercial bank, and then they get Naira liquidity. And then obviously you solve for the delta between the interest rate and what you get. But out of the blue, the CBN came and, basically prohibited that. Obviously that has an impact on, in terms of appetite for domiciling locally. We also spoke about logistical things like the ease and difficulty of movement of funds within the country. And I think that summarizes it. Team, is there anything that I have missed? All right, thank you.
Thank you so much, Mr. Bowfani. I call on the next person, Ms. Amaka Okechukwu, who will be delivering on their discussion around gender lens investing considerations for local fund domiciliation. Thank you.
Hello, thank you everyone. So Amaka Okechukwu, founding partner of Weave Capital, happy to be here. So we were talking about gender lens considerations. I think the first thing that came out, and I think it's very important to set the scene, is that at the end of the day, the biggest consideration is the macro, right? Really, if you fix the enabling environment, you fix a lot of things, right? So the first thing we wanted to highlight is that whether for, irrespective of gender lens considerations or for gender fund managers or female fund managers, the most important thing is to attract capital. And to attract capital, we must fix the macro. And so that's things around, I think, what we've just heard. The capital controls have to stop. If someone puts money in, they need to be able to bring money out in dollars. Looking at FX risk, yes, we can hedge. It's quite expensive, but effectively we need to solve the macro. Tax considerations, double taxation treaties, these are the things that we need to do. So we need to fix the top line first. So if we fix that, then let's talk about the gender lens considerations. If we really want to attract capital, we need to think about it with gender considerations, and I think that's very important. To do that, a couple of things come to mind. We thought about a Mauritius, right, as an example. And one of the interesting things with Mauritius is that, typical funds, you can only have 99 investors, LPs, individual limited partners in the fund. And so that limits the types of investors you can have. So if you're a $25 million fund, as an example, it means that every single, the average, the smallest ticket size you really should be taking is 250K. And so that puts a limit on who can invest in your fund. And gender considerations. So when you're looking at even having female investors from a limited partner perspective come on, you reduce the chances of that happening if you don't, if you have certain regulations in place. So we want to be very, as Nigeria goes around our own process, let's, learn from, I guess, some of the weaknesses in other jurisdictions. We also talked about the funds, and just the cost of setup. I think it's a recurrent theme. That cost is super important, especially when you think about most gender lens funds or female fund managers are also, most times first, second time fund managers, it's still very nascent. And so the fund sizes are usually smaller, sub 50 million. And so they're very cost sensitive. And so those cost implications become even more paramount in a when you're thinking about it with the gender lens. So we really need to think about how do you balance that high risk, those high costs, whilst ensuring that you're not taking on too much risk. So we had a very good conversation on this because, you look at a jurisdiction like in Mauritius, where it costs anything from $50,000 to $100,000 a year to run a fund. And you say, okay, that's quite high. And we don't want that. But there's a reason why sometimes it's high, right? Because of just the amount of work it takes to do the AML, the KYC, the checks, the fact that you have to audit your fund every year. So we want to say, how do we keep those positives, right? Ensuring that there's really rigor in the funds that are being domiciled in our jurisdiction without making it too punitive. And so we talked about having, balancing that risk and then potentially having a segmented, tiered pricing strategy for funds that are gender smart, for smaller funds, to really take that into consideration. So that tiered, differentiated pricing and cost structure is something that came up. The third thing that we talked about was incentives for gender smart funds. Now, these funds don't have to be managed by female fund managers. We love female fund managers, by the way. But it could also be male-led funds that are gender smart, and thinking through what sort of incentives can we put in place for these funds. These could be tax breaks, and thinking through what sort of messages do you want to put in place. So I'll give an example of Mauritius again, right, where they require that you have 2 directors that are local, that are Mauritian, as an example. What can we do in Nigeria, perhaps, to say, okay, fine, there are, you put a certain percentage of women on boards, on ICs, in funds, and not mandating it, by the way, but creating incentives for those that do. Looking at whether, what percentage of their investments go into gender lens or gender smart investments, and having incentives in place to encourage a certain type of investing. The fourth thing we talked about was data. And by the way, on the incentive structure, this is also not new. I think we've seen that in jurisdictions like in the EU. There are quite incentives for gender smart funds. So I think it's something we can also look into. From a data perspective, data is key. We had very interesting conversations around, evidence-based data, and saying if you want to channel more capital into something, then you need the data to show that this is a profitable investment. So we talked about just ensuring that we get more data, and if we link that to my last point on incentives, once you create the incentives in place, then you get more funds to provide data on whether it's number of people on their boards, whether it's types of investments that they're doing. So we need that data to support the industry. And the last thing is really about capacity building and awareness as we boost and and continue these conversations. We're very happy that there was a specific session on gender, and we think it's important that you continue having that discussions on capacity building and really just awareness with both the regulators and service providers on the importance of just having these gender considerations as we think through our regulations. So thank you so much. That was it.
Thank you so much. Up next is Ms. Abiola Dabiri. She will be speaking on tax considerations for local fund domiciliation. Please, you have 5 minutes.
Okay, I don't need 5 minutes. All right, we had a very good conversation, but the table is so empty now, it feels like we talked to ourselves. So we started off from what was the end goal. What is utopia is to have tax should not be a deterrent, right? It should be a form of an attraction for local domiciliation. So it should drive investments into funds in Nigeria and to unlock capital. So we then looked at what are the concerns or what are the drawbacks that people currently face when you do that. One is multiple taxation, and we talk about the different taxation and sort of lack of clarity on what you're doing. And it may be clear to us, but to an external party, and the last speaker helped my case a little bit on Mauritius. So we said that there's a system in Mauritius when you want to pay tax. It's a platform. You put your entity there, you put your name, you put what you earn, it generates quarterly. You cannot amend it. The only time you would have a conversation with a person is if the revenue authority either questions your financials at year end or something, and then you pay your tax. So it gives an efficiency. So as for Nigeria, when we start to look at that, is to create a tax system that makes it clear and easy for both fund managers and third party or fund investors to look at it and say, we understand what we're getting into when we go into Nigeria. The other part is to think of a way to make it less complex. We may understand the complexity. We Nigerians are complex, but we understand our complexity. But when you're presenting it to a third party and you're trying to raise capital, then they're looking at you like you're speaking Arabic, and then you have to keep explaining. But if we have infrastructure in place that makes it very clear that, I would say that when they do the comparison of tax regimes in 3 jurisdictions, 4 regimes, they can be clear on what you're paying in one jurisdiction. If you're comparing Nigeria, Dubai, Mauritius, you can easily say, this is what is required from me. Then also we felt there was need for increased stakeholder communication. And that means that forums like this, conversations with stakeholder on tax, primarily to also address the thinking about tax. Yes, tax is a revenue driver, but tax can also be an attraction. There are several jurisdictions that have used tax as a principle for attracting foreign investment or local domiciliation. And we thought that's an important thing to think about. And then tax incentives. I know sometimes given the state of development in Nigeria, you worry about saying tax incentives, but tax incentives can also be an attraction. So for example, in certain jurisdictions, if you paid your tax early, there are certain rebates or you get. So should we think about gender-based tax incentives as it relates to particular areas of development that we require, but that is clear and that is reviewed, as opposed to, not knowing, or knowing, but we may know, but it then is subject to interpretation. Because when something is subject to interpretation, it leaves room for, people making all sorts of assumptions. Then finally, we talked about just essentially putting in place, sorry, someone's distracting me. Someone's distracting me. So putting in place a system that integrates both what we have currently but also across the states. And we talked about a scenario where you could be a fund, but then you are in a special economic zone in Ogun State, and then you are dealing with, I mean, unless you are there, you are going to be asked, are you going to pay LIRS, FIRS, OIRS? But that clarity in terms of the system and the platform, because in those other jurisdictions that we are competing with, they don't have that confusion. And we need to clear that. Thank you.
Thank you very much. A round of applause for her. Then presenting on legal and regulatory considerations for local fund domiciliation, Ms. Michelle Chikeze.
Thank you. My name is Michelle. I'm a partner at GLI. So we're discussing legal and regulatory issues on local fund domiciliation, and it was a very interesting conversation. And I would say, in summary, we need a lot of engagement among, private, those of us here, as well as, private associations with the government on policy, on the regulatory framework. And we identified three areas where we need that. The first one is the constitutional issue, right? So before we had CAMA, Companies and Allied Matters Act 2020, before we had that, we didn't have a legislation under which you could register a limited partnership, for instance, and an LLP. Then the Lagos State government came in with the Lagos State Partnership Law, under which some funds were registered, a few funds, and other entities, LPs, were registered. But when we then had the CAMA 2020, CAMA 2020 came in with, the limited liability partnerships, and also the limited partnership, right? So what the problem is that there is a conflict there, and it's a constitutional conflict. Neither the exclusive list nor the concurrent list, list partnership as being within the legislative competence or jurisdiction of the National Assembly or State House of Assembly. So that's that. And why that's a problem is that in the Lagos State Partnership Law, if you are registered, and if you're registered as a partnership under CAMA, then Lagos State law requires you to also be registered under the LPL. So we need that to be confirmed, the status of that law. It hasn't been judicially determined. And also under CAMA, if you're just registered under the Lagos Partnership Law, you would just be considered a general partnership, right? So that's one thing that we need to engage on, and we identified that the IIF would do that. And then the second is on domiciliation of funds. And one of the things that we discussed, the second thing we discussed is that a lot of the issues and challenges and bottlenecks that we have raised, it's really, economy is just a Nigerian factor, right? So many things, and whether it's the macro or whether it's the regulation or whatever it is. And thinking about this, you guys had talked about the international financial centers, but we talked about it in a wider sense. Getting this fund, getting a special jurisdiction for fund domiciliation in the free zones. And we're getting that inspiration not just from there's a Kigali IF's International Financial Center, and there's also the one in Dubai. Yes, Lagos State is discussing, but also we see special jurisdictions like what Itana is doing. I don't know if we know about Itana. Itana is a special economic zone. It is actually trying to build a virtual economic zone, special economic zone, such that you can have a virtual company, you can register, you can be outside Nigeria, and you're registered in Nigeria and you're operating in the free zone, right? And then you enjoy all the tax benefits for the length of time that you have it in the free zones. Apart from that, you bring in US dollars, you take out US dollars, so that conversation is a little better on repatriation of, and then also you can have special governance provisions, right? Because the laws that apply to free zones are a little different, and we can actually make a carve out from those that apply in the customs territory. So that's a conversation we need to have, and I believe strongly that if we should engage lawmakers, we should engage policymakers as part of I know there's DIFSIN, which is a non-profit that's currently engaging with executive arm and with some of the departments to, especially NEPSA and the Ministry of the what's it called, the Ministry of Justice, to nuance, edit the framework, the current free zones framework, to nuance it such that it can apply to service-based businesses, businesses that essentially you can carry out remotely. You don't have to be physically present. That's the same type of business as funds, a service-based business, right? So that's the second thing, and I just have a very short time. So the last point is on the tax. So we were looking at what conflict, what nuances, and we discussed also LLPs, limited liability partnerships are being treated as companies. So there's that pass through that you see in other jurisdictions is not applicable here, based on one FIRS circular that came out a couple of years ago, and also the tax reform bill. Actually, the tax reform bill, there are two problems. The first one is that it's treated as a company. So there's a corporate tax and you pay tax at the partners level as well. But more so, profit is being deemed as distributed to the partners even when it has not. So based on your reporting or your valuation or whatnot at the end of the year, even though money has not gone to partners, you can get, you're deemed to have that income as an LP, and you have to pay taxes on that too. Thank you.
Thank you so much. A round of applause for her, please. And last but not the least, presenting the takeaways from the online conversations, Ms. Regina Alabi. Hello, Ms. Regina, can you hear me?
Yes, I can hear you. Good afternoon.
Good afternoon.
Everyone. My name is Alabi Regina. From AMFIN, Association of Non-Bank Microfinance Institutions in Nigeria. So here are some of the insights. We look at three things. Number one, we look at the gender lens investing consideration for local fund domiciliation. We talked about having a regulatory framework that encourages gender lens investment. Okay, then we also talked about incentive, like offering some incentives, like tax breaks, registration fee waiver. This will encourage gender lens lending investment. Investing in Nigeria, and also impact on the impact-based funding. We also talked about, we also have another point as gender impact reporting and measurement, as well as capacity building for fund managers and investors. This will also encourage them. Then we also look at another thing, fund managers and investors' perspective in consideration for local fund domiciliation. Now, number one of the things we actually point out there is that the private sectors should make themselves available to be carried along when there are new regulations that will discourage fund domiciliation. Number two is that we also believe that there's need to introduce dynamic and flexible investment vehicles, such as limited partnerships, variable capital companies, and social funds. You know, if you look at this, this could be a game changer as well. We talked about, we should have a very simple process for fund registration, like having a one-stop shop for fund registration model, which will be very great. We looked at having a work with the regulatory, that we must work with regulators to design gender-friendly investment policies. It's not just the regulators that will just come up and do that. The enterprises should be carried along in doing that. Another point we also looked at is, because of time, I'm rushing because of our time, we looked at the legal and regulatory considerations for local fund domiciliation. We pointed out the weak asset qualities, or also look at the ineffective regulatory oversight and high non-performing loans, and inconsistency in policy environment, which we saw as some of the major impediments to local fund domiciliation. Secondly, if you look at how it is in Nigeria currently, there are unclear private equities or venture capital regulations. So there's no dedicated legal framework, especially specifically for private equity and venture capital. So if the regulators and even the government can look at that and see how that can come in place, that will go a long way in helping. We also talked about another area, which is the frequent policy. Can you still hear me? Can you still hear me? I think my network is actually acting up. Can you hear me?
Yes, we can hear you.
Okay, so we talked about another area, which is frequent policy changes and government intervention, which create an unpredictable investment climate. Another point is company law, which doesn't provide flexible structure, such as protected style companies. That is another key factor that must be looked into. We have rigid company law requirements in fund friendly jurisdictions. The company laws are flexible and dynamic in other countries. So in Nigeria here, we can look at that and make it work. We must also have we also thought of having a weak contract enforcement in Nigeria. So there are other points, but then because of our time and the network issue here, I think we can leave it at that. I will leave it open for some of my team members or online partners to contribute effectively. These are the ones I could capture. Thank you so much.
Thank you so much. A round of applause. I'm so happy that we have been able to achieve a quite an engaging session with also our members, the participants online and also here in the room. Somebody's hand was up. Mbotidem, your hand is up. Do you want to?
Good afternoon. Good afternoon. We had a great conversation on our with our team, and I think I just want to point one thing very important. I know Madam Etemore Global said something about gender-lens investing. It's important that we should begin to think about that and also have a tailored training for local fund manager. I think it's really, really important. Thank you so much.
Thank you very much, Mbotidem Jackson. I think that is quite a good point he raised for training for local fund managers. I really, really want to thank everyone for your participation and for staying this long. We understand your busy schedules and really, really appreciate. Giving us the closing remark is Ms. Chizoba Emmanuel Awakesian, the CEO of Impact Investors Foundation. Please, a round of applause for her. Please, let it be louder. She's the one. Please. It's not loud enough, my people. Please, more, please.
Good afternoon, everyone. Thank you all for being here till now. Good afternoon, our esteemed guests, fellow ecosystem builders, investors, partners, and colleagues. As we bring this insightful and engaging Investors Roundtable to a close, I want to sincerely thank you all for joining us today and staying engaged throughout today. Your presence and active participation have truly enriched our discussions and made this event a resounding success. Our theme today, Catalyzing Impactful Investments in Nigeria, Unlocking Opportunities, Driving Sustainable Growth, has set the stage for critical conversations around mobilizing capital and scaling impact initiatives in our ecosystem. Throughout today, we engaged in inspiring and thought-provoking sessions. We began with an insightful opening remark from our CEO, Ms. Etemore Glover, who reminded us of IIF's mission to advance impact investing in Nigeria. Insightful keynote speeches from Mr. Benson Adenuga of BII and Tosin Ojo of Sahel Capital, highlighting the current investment landscape, challenges and opportunities, and also the fact that sustainability of financial returns is at the core of impact investing. Engaging panel discussions where industry experts provided clarity on how to attract and mobilize capital for sustainable investments. Breakout sessions where we examined key enablers for local domiciliation, policy consideration, and strategies to enhance impact capital flow in Nigeria. The MasterCard Foundation's domiciliation study presentation, which gave us a fresh perspective on how increasing fund domiciliation in Africa can unlock capital and international capital. Most importantly, how to mobilize this capital in Nigeria, what needs to be tweaked in our regulatory framework to ensure that Nigeria is attractive for fund domiciliation. From our panel discussions and breakout sessions, some key recommendations emerged. 1, enhancing local fund domiciliation to attract more international capital. We need clear investor-friendly policies and robust regulatory frameworks. 2nd, increasing domestic capital mobilization. Pension funds and institutional investors have a vital role to play in funding impact-driven businesses. 3, scaling up catalytic capital. Blended finance, risk-sharing mechanisms, and innovative funding structures can be used to unlock investments in high-impact sectors. 4, building stronger investment infrastructure. By providing legal frameworks, taxation policies, and financial services, Nigeria can become a more attractive investment destination. What's next? At Impact Investors Foundation, we are committed to ensuring that today's recommendations do not just become just mere discussions, but translate into actionable steps. How will this be done? 1, policy advocacy. IIF will continue working with policymakers, regulators, and financial institutions to create an enabling environment for impact investing and fund domiciliation, ensuring that regulatory frameworks efficiently support both investors and investees. 2nd, implementing the catalytic capital roadmap. We will work with stakeholders to adopt and implement a roadmap that prioritizes deploying catalytic capital where it can make the most impact, particularly in underserved sectors like agriculture, healthcare, and renewable energy. This roadmap will be a living document, continuously tracked, refined, and evaluated over the next year. We will convene in 2026, and when we do, we should be able to look back and measure the progress that we have made in advancing and deploying catalytic capital to where it is most needed. 3rd, strengthening partnerships. We cannot achieve this alone. We will continue to collaborate with all stakeholders, including investors, financial institutions, development partners, and ESOs to ensure that capital flows efficiently to drive sustainable development. 4, engage with regulators, further engage with the SEC and other regulatory bodies to ensure that regulations evolve in line with market trends, particularly in the context of alternative investments like infrastructure funds. 5th, enhance service provider collaboration. Service providers, including lawyers, auditors, custodians, should explore ways to better integrate their services to create a more efficient and cohesive experience for fund managers and investors. Increase awareness and education. There is need for more education and awareness building for capital providers, particularly pension funds, about alternative investments to increase willingness to invest in these classes. We invite all stakeholders here today to partner with us to implement these next steps. Together, we can drive transformative growth. This event would not be possible without the dedication and the support of several individuals and organizations. First, the IIF board, led by Mr. Frank Aibogun. I want to thank you for your strategic leadership and guidance. Our CEO, Ms. Etemore Glover, for her visionary leadership and steadfast commitment to advancing impact investments in Nigeria. Our funding partners, Riser Fund and Ford Foundation, for their unwavering support in building the thriving impact investment ecosystem. Our strategic partners, Wema Bank and others, for their continued collaboration in strengthening Nigeria's investment landscape. I want to extend a special thank you to all our keynote speakers, panelists, moderators, roundtable leads, participants online and in person. You all have made this event a success. The IIF team for working tirelessly behind the scene to make this event a success. And a special thank you note to our deal matchmaking manager, Ms. Tochi Ginigeme, for her dedication and hard work in ensuring that this event is a success. As we continue to work together, I want to personally invite you to 3 of our upcoming events in 2025. First, our 3rd Gender Impact Summit. The 2nd, the study tour to Nigeria, which is taking place June 8th to 10th. It is the precursor to the Africa Impact Summit holding in Accra, June 11th to 13th. And the 3rd, the 8th annual convening in November. We'll be thrilled to have you all join us at these events as we continue to foster collaboration and drive impact investing forward. As we step out of this room today, let us remember that the real work begins now. The insights, connections, action points generated here must translate into tangible impact. Together, we can unlock opportunities, drive sustainable growth, and shape the future for impact investing in Nigeria and beyond. Thank you all once again for your participation. I look forward to seeing you at our next engagements. Have a wonderful day and God bless. Thank you.
Thank you so much. Please let us stand up and appreciate her, please, for being a wonderful host. And with this, we draw the curtain on this wonderful event, the Impact Investors Foundation Investors Roundtable of 2025. Thank you very much. Please, a round of applause for yourselves. Also, those online, please do clap for yourself and do enjoy the rest of the day. Please, the next in line, we're going to have a group photo. Please, everyone, join in for the group photo. It's everyone, please. We need to actually join the group photo. Please let us make our way to the stage for group photo, please.